automatic. Problem is when I'm with you, I'm an addict. And I need some relief. My skin ain't your teeth. Can't see the forest through the trees. Got me down on my knees, darling, please. Oh, I lose control when you're not next to me. I'm falling apart right in front of you. Can't you see? I lose control when you're not next to me. Yeah, you're breaking my heart, baby. You make a mess of me. I lose control when you're not here with me. I'm falling apart right in front of you. Can't you see? I lose control when you're not here with me. Yeah, you're breaking my heart, baby. You make a mess of me.
I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. Wanna get numb, go crazy, wanna wild out. Cause lady, life's so short but amazing. Late night party in the basement, hotel lobby and I'm wasted. Just reached into my savings, I'll do it too if you take it. Yeah, life's only what you make it. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb.
Please welcome to the stage our hosts, Bloomberg's Derek DeCluett and Caroline Gage.
Good morning. I'm Caroline Gage, head of editorial for the Americas for Bloomberg. Welcome to the 12th annual Canadian Finance Conference.
I'm Derek DeCluett, managing editor of Canada for Bloomberg News, and I'm very glad that you could all join us.
Today we'll hear from a range of business, government, and finance leaders about their fields and the broader backdrop in Canada.
We're continuing with the tradition of providing timely insights and strategies for our global audience of leaders and decision makers and investors. Before we get started, we have a couple of housekeeping announcements.
First, we would like to acknowledge our sponsor, National Bank of Canada Financial Markets.
For our virtual attendees, if you experience any issues with the audio or video, please try to refresh your browser first or use the chat box in the bottom right corner of the screen for support. For accessibility, we've partnered with an audio-to-text platform which will transcribe the discussion in real time. You can access that transcription via the link in the session description.
We would love to hear from you throughout the program. So to submit questions virtually, please click open the white tab on the right side of the video window. And for those of you in the room with us, you can submit questions by scanning the QR code on the screen.
And if you want to engage with us on social media, you can do so, and please use the hashtag BBG Canadian Finance.
With that, please welcome Tom Clark, Consul General of Canada in New York, who will share with us some opening remarks.
Just so you know, that's not my usual walk-in music. It's a little bit bouncier than that. Anyway, good morning, everybody, and thank you, Carolyn and Derek, for the introduction. Bonjour, mesdames, messieurs. Il me fait grand plaisir d'être avec vous ce matin. Thanks very much for joining us on this. First of all, I want to extend my gratitude to both Bloomberg and National Bank for convening this conference. It's an exceptional conference, and as you can see on the program, you've got a pretty impressive lineup of panelists and speakers. This is the 12th edition of this conference, and I think that after you've done 10, you can declare it to be a success, so there are 2 past that right now. But it really is a testament to the dedication of both Bloomberg and National Bank that this is now 12. Their commitment to delivering valuable insights into the Canadian economy and capital markets really is truly commendable and a great help to somebody like me. On a personal note, this is my second conference since arriving in New York as the Consul General, and much like High Level Week at the United Nations in September, this annual conference has become sort of a key milestone for me, marking the transition from summer to fall. Although with the weather in New York these days, you might not know it, this is not a traditional Canadian fall. This is a little warmer than that, perhaps spurred on by a few things going on in this country at the same time. But this is a unique event that gathers an impressive array of economic and financial experts to delve into my favorite topic, and that is Canada. So give me a minute or two. I'm excited to see a distinguished gathering of issuers, buy-side investors, and market intermediaries from both sides of the border in the room today. Your collective presence underscores the essential role you play in facilitating the vital flow of capital between our two nations. Today's conference is a unique opportunity to explore the vital connections between the United States and Canada, whether through capital flows, investments, or trade. The conference offers a remarkable platform to highlight the significance of the Canada-U.S. relationship. The bond between our two nations is unparalleled, as no other two countries rely so profoundly on each other for mutual prosperity and collective security. The value of our economic partnership cannot be overstated, but it can be measured, and it's pretty impressive. Bilateral trade of more than $1.3 trillion last year. That's about $2.5 million every minute, 24 hours a day, 7 days a week. Or let's put it another way, this speech will last about 5 minutes or about $12.5 million. And I think that's pretty good value for the money. Now here's another value, another measure rather of the relationship. More than 2.2 million jobs in Canada depend on exports to the United States. And more than 7.8 million jobs in the United States are related to trade with Canada. We are literally in each other's kitchens. Our connection is rooted in shared geography, history, but more than anything else, it is rooted in values. Put simply, we believe in the same things. Prime among them is enhancing the well-being of our citizens. We often hear the term friend-shoring, but I prefer to use the term value-shoring, because friendship, especially among nations, sometimes simply doesn't survive, but values are eternal. This deep cooperation has forged one of the most prosperous and open regions anywhere in the world. In fact, I would wager that there are no two other countries in the world that share a border that wouldn't in a nanosecond change their situation for ours. Although we have faced our share of differences over the years, our ability to resolve these issues speaks to the resilience of this partnership. This enduring relationship has weathered changes in government on both sides of the border because both Canadians and Americans understand that If one of us does well, then so does the other. Now, we understand the desire to bring business home to provide jobs and opportunity here instead of abroad. But we can't do that at the expense of what we have built together for more than a century. Neither country can do all that the future demands of us alone. The road to America's goals run right through Canada and vice versa. Yes, let's rebuild and rationalize our supply chain so that a conflict on the other side of the world doesn't tear our economies apart. Yes, let's innovate and invent our way out of existential threats like climate change, but let's do this together. Buy America? Well, how about buy North America? Collectively, the richest, most advanced region of the world. We've already shown we can do it, too. Take a look at the automotive industry. All the pieces that make a car on the streets of New York today have likely gone back and forth over the Canada-US border 7 or 8 times before being sold in a showroom in Brooklyn. Our economies are so integrated that pulling them apart would be a fool's game, and an expensive one at that, and it would impoverish both sides. Now, a very brief word about what this country is facing on November 5th and how it might affect us. We are very clear about this. We will work with whoever the American people elect, whether that be in the White House or in Congress. And while we will adjust to any change that happens in this country, what we're going to focus on are the things that don't change, and those are the issues. Those are the matters that concern us. Energy, the future of semiconductors, the future of our shared national security. Those issues endure, and it is on those issues that our two countries do well. The new economy, the electrified AI-based world, needs really just 4 things to take hold. It needs land, water, energy, and talent. That's it. That's the secret sauce right there. And we have all 4, both in Canada and in the United States. We also have the capital to actually make it grow. And few, if any, other regions in the world have it so good. Why wouldn't we want to nurture this garden? But it's already started. From critical minerals to the development of EV batteries to semiconductors that will power the present and the future, we together, as I said, have it all. Let me color all of this with some sound economic context. Recent years have been characterized by elevated interest rates and tighter liquidity across many countries, including Canada, resulting in increased costs for capital for businesses and higher financing costs for consumers. Now, as we gather for this conference, inflation in Canada is now back on target at about 2%. It's actually 1.6%, while the labor market is starting to ease, setting the stage for more rate cuts to ensure a soft or softer landing. Essentially, in my mind, we're looking at a potential return to pre-pandemic conditions, a scenario that, frankly, many of us would welcome after the challenges of the past 4 years. And the story coming out of Canada is indeed very promising right now. Canada continues to hold its AAA credit rating, a testament to its sound fiscal management. Our public deficits are relatively modest and declining, and our net debt to GDP ratio is well below that of our G7 peers. Our financial system remains robust and resilient, providing a solid foundation for economic stability. The IMF projects that Canada's real GDP will grow by 1.3% in 2024, making it the 2nd fastest growing economy in the G7, just behind the United States. For 2025, the forecast is even brighter, with a 2.4% growth rate that could see Canada leading the G7 in economic expansion. While Canada's economy remains strong and resilient, we must stay vigilant in tackling some key domestic and global challenges. Those include housing affordability, inclusive growth, and the transition to a clean economy. On this last point, Canada is leading the global race to attract investment and harness the opportunities of a clean economy. Our government has announced an ambitious net zero economic plan committing over 160 billion Canadian dollars to this crucial transition. This plan features a groundbreaking suite of major economic investment tax credits expected to provide $93 billion in incentives by 2034-35. These credits will support investments in critical aspects of the transition to a clean economy, such as carbon capture, utilization, and storage, clean technology adoption and manufacturing. So about our ability to sell electricity to New York. That was the next thing on my list here. It said clean electricity. And of course, the other advantage we have is the EV supply chain, the massive investment that Canada has made in battery technology. Canada also boasts some of the largest known reserves of rare earth elements, estimated at over 14 million tons as of 2021. Through our critical minerals strategy, we are actively funding a diverse array of industrial initiatives, from geoscience and exploration to mineral processing, manufacturing, and recycling. This includes robust support for R&D and the deployment of cutting-edge technologies. Our friends at Bloomberg NEF recognize Canada as one of the most promising countries for building a reliable EV supply chain. As they aptly put it, don't sleep on Canada. Remember, about $1 million ago, so a couple of minutes ago, when I talked about our mutual reliance. Well, a shining example of this collaboration in our backyard right here is the Champlain-Hudson Power Express. When completed in 2026, this project will deliver 1,250 megawatts of reliable, clean hydroelectric energy from Quebec to New York City. That is enough to power over 1 million homes, helping to combat climate change and reduce harmful air pollutants. It is going to be supplying New York City with about 20 to 25% of its electrical needs. That's huge. It will reduce carbon emissions by 37 million metric tons statewide, the equivalent of taking over 500,000 cars off the road every single year. So, look, Canada remains an exceptionally attractive investment destination for U.S. and multinational companies. Their success not only drives our growth, but also strengthens our economies, laying the groundwork for shared prosperity and a very sustainable future. Merci beaucoup. Je vous souhaite une excellente journée. Thank you very much, and thank you, and enjoy the day.
Please welcome to the stage Stéfane Marion, Chief Economist and Strategist for the National Bank of Canada, for a conversation with Bloomberg's Christine Dobby.
Good morning, Stéfane.
Hi, Christine.
How are you doing?
I'm good, thank you.
That's good. So I know that this is always a very interesting discussion. You're a very in-demand person, and we have a few of your classic slides to reference during this conversation as we go through your outlook for Canada. And I know you're not going to give me a straight or easy answer to this, but I'm going to ask anyways. Let's start with your view on the Bank of Canada's next interest rate announcement, which is next Wednesday.
You're jumping the gun. I'm not going to answer this now.
Okay, let me set the stage a little bit. So over the past week, we've had a bit of conflicting data here. You know, stronger than expected jobs numbers on Friday, weaker than expected CPI yesterday. You have said that the bank needs to be more aggressive in cutting. If you will, could you tell us what you think the bank will do next week and what you think the bank should do next week?
Okay, so let's run through a couple charts, and I promise I will answer. Give me a couple minutes.
Okay, we're going to start with everyone's favorite topic in Canada, population growth.
And it's not that I don't want to answer your question. I just want to show you how complicated it is, and I'll let people in the room decide what the bank should do.
Yeah.
They may have the same forecast I have. There's no other country in the world where a central bank is facing this dilemma facing population growth. It's the basics of how you determine what your potential GDP would be. Mm-hmm. Now, in the past 12 months, we've added 1.2 million people. The previous record before that was last year, 1 million, and the prior record before that was 800,000 the year prior. So back to back to back, record population growth. Prior to that, exceeding 600,000 population growth in an entire year. You have to go back to March 31st, 1949 at midnight when Newfoundland joined the Federation. So these are massive numbers. If I put on the global scales, 3.2% population growth in Canada, number 5 in the world, and the top 20 countries, all the others are located on the African continent. So never before has the Bank of Canada dealt with this type of environment.
And so here's a question for you. Is population growth inflationary or deflationary?
Now you're getting into the interest rate forecast, which is interesting. The Bank of Canada has denied that it was a supply shock, so they thought it was more inflationary. And when you add 3 million Canadians in 3 years, we normally do that over a period of 8 to 10 years. So this type of population surge has meant that rental vacancy rates, home vacancy rates have plunged, leading to a very interesting, unprecedented dynamic on inflation. No other countries is facing that. And I think you have it on another slide.
Right, so this is another favorite topic in Canada, the cost of housing.
Yeah, so if you look at, as of yesterday's number, clearly population can be inflationary for some components of the CPI. 30% of the CPI is composed of shelter in Canada, and we're running at 5%. So based on that alone, you could say, well, the Bank of Canada, we're facing a demand shock from surging population growth. But we would argue that you have to look beyond this, because if you exclude the shelter component on which the Bank of Canada has no control, we're talking about CPI ex shelter at 0.4% right now. Christine, as of yesterday, we have 6 Canadian provinces where inflation is below 1% or below, and 4 provinces where if you exclude the shelter component, it's actually deflation.
Right.
Now, to your question about the Bank of Canada forecast, are they inflation targeters or not?
Yeah.
Well, if they are, they have to look beyond the shelter component.
And so that's something that the Bank of Canada fairly resolutely said that they would not look through, at least until the end of last year.
Yeah.
Do you think that that was a mistake?
I think they've changed. They're focused on this, and they've switched from seeing population growth as a demand component on inflation to something where you have to look at the population growth as a potential source of supply, which means you have more excess capacity in your economy. And when population surges, presumably, Christine, when you have monetary policy that is restrictive, well, maybe you need to do some adjustment. And the Bank of Canada last April came out with a very interesting study. They look at 32 labor market indicators, and they say the one that is most correlated with future inflation, is actually the unemployment rate of young men.
Right, and so obviously another huge element related to surging population. And this is striking when you look at the unemployment rate for young Canadian men.
Yeah,
it's high, and it really diverges from the similar rate in the U.S.
And again, I don't want to dismiss the impact of women on future inflation, but it's just that it has to do with the industries that young men work in, and it's not my study; it's the Bank of Canada. So if you don't like the conclusions, you can speak to them. But this is a big deal. So coming back to your question, the initial question, you have CPI ex shelter at 0.4%. And the unemployment rate for young men at the highest level in over a decade. So what do you do at the end of the month? Of course, you cut 50 basis points. And what do you at the following meeting? Of course, you cut another 50 basis points, because we all know that the neutral rate is closer to 3%. You have to get to 3% as quickly as possible.
Where do you think the rate is within a year from now?
Lower.
Lower.
Yeah.
Lower than now.
Well, how low we're going to get below 3% remains to be seen. But the first step is for the BOC, the Bank of Canada, to bring us to 3% now. We needed to be there yesterday. So let's get to it.
Right. Okay. And so your prediction is that the bank will do 50 basis points next week, or that's what you think they should do?
They have to do 50 basis points.
Yeah, and you think that they will?
Yeah. Well, with inflation like this?
Yeah.
With this? Yeah.
Okay. And so based on all of this, where do you see GDP growth going in Canada for the rest of this year and for the rest of
Well,
next
Tom's not going to
year?
like me. There's no way we're going to do 2% next year, so
Yeah.
we're going to be at 1.5%.
Yeah.
And monetary policies are restrictive. I don't know how the IMF comes up with this study, but this conclusion, but we're going to go below. We're going to be below 2%. We have to be below potential next year, because monetary policy is not going to be accommodative before the second half of next year.
Okay. When you and I were preparing for this, we did talk about there's some economic upsides to the surge in population.
For certain industries, right?
For certain industries, and I happen to cover the financial industry, so we're going to do a little illustration on that. But can you talk us through this?
Well, when we do market internationally, people ask me, Stéfane, where are the Canadian financial institutions finding the new clients? Well, as it turns out, 81% of the working age population actually borrows from a financial institution in Canada. It's the highest proportion in the world. So when I tell people we get 81% of 3 million people, well, that's a lot of clients, right? So this speaks to where demographic growth has some challenges, but also some opportunities for certain industries. And clearly for financial industries, it's been quite positive, right? And access to banking in Canada is one of the most significant in the world. So 81% of 3 million people, that's a lot.
So, and then the demand from all of the newcomers also fuels industries like the grocery sector, like the telecom industry.
Oh, absolutely.
But those also, the rising costs there contribute to inflation. So
But the Canadian supply chain was never designed to accommodate a surge of 3 million people in 3 years. So these were not price gouging. The profit margins at grocer was the same, but you've added an influx of people, and at the same time, we had to adapt the supply chain to accommodate this surge in population. Notice also on this chart, the U.S. is only at 65%, and our other North American trading partner, Mexico, is at 11%. So clearly, from a financial institution standpoint, you can understand why financial institutions in Canada have outperformed their peers with this population surge.
Okay, I would just like it noted for the record that you said the grocers were not price gouging, so I'm sure the grocers would thank you for that one. It's obviously been a big debate as well in Canada. We want to see, you're a bit pessimistic about Canada's growth prospects.
Short term.
Short term.
Yeah.
But where do you see it going long term? And sorry, the productivity issue is a huge topic in Canada, and we're not going to solve that today. But do you see any potential bright sides to productivity in Canada?
I think there is some upside. We haven't been as good as attracting investment as we did for a population, or foreign talent are coming to Canada. Now we need to do better in attracting investment, right? And I think going forward, where we do have a few aces up our sleeves in Canada, first of all, I'll start, do we have, what's the next one? I forget what that was. Electricity.
Yes, coming back to...
a reliable source of electricity, which we didn't get in the past half hour here, right? So I think that's a big deal because Tom was speaking to electricity, but I just want to make clear that Canada's electricity grid is 50% cleaner than the OECD average. So if you're looking for a clean source of energy down the road, or from an ESG standpoint, Canada is really a standout. Our electricity grid is 2 times cleaner than the US grid, 4 times cleaner than China's, 5 times cleaner than India. And by the way, Christine, our electricity costs are 60% below the G7 average for both households and industries, and 20% cheaper than in the US. So if you think about Canada, productivity down the road, this whole AI concept, which is electricity intensive, I can think of no better places to look for electricity. You have to come to Canada. And this is crucial for me because I will determine our future competitiveness and, as you said, reposition us for doing better on the productivity side of things. Absolutely.
So we have some of the pieces there. Obviously, there needs to be some execution around it.
We need to better execute. You're absolutely right.
But your point is, we have a clean grid. We have cheap electricity. We're poised to take advantage.
We should be marketing Canada to the rest of the world to say, like, if you want to.
Canada. Another factor that you see as an advantage that we were talking about when we were preparing for this, ironically, is government debt. This is not usually seen as an advantage, but and the deficit is a big topic. You know, government spending has been quite steep, particularly since the pandemic. Why do you think why is there an upside or potential upside in Canada's government
This is the other ace up our sleeve, because the IMF came out yesterday with a new study about surging government debt wherever you look. And it's important for Canadian corporations, by the way, the story about net versus gross debt. It's extremely important.
Yeah, so why is Canada's net debt so low compared to other countries?
The difference between gross debt and net debt is really the financial assets that are owned by the government. And they're not directly owned by the government. There really is a concept. It's the pension funds, right? So Canada decided back in the 1990s that they were going to recapitalize. We were going to recapitalize our pension funds to make sure that they remain solvent for the foreseeable future. And the difference between gross debt and net debt is really the financial assets held mostly by the pension funds.
And so which pension funds are we talking about here? Primarily CPP?
CPP, Caisse de dépôt,
Right.
but also OMERS, teachers,
Sure, all the
these
public
Canadian
sector
pension
funds.
Yeah, absolutely. Yeah. And that's a big deal because you don't have to worry about Canada being a pay-as-you-go government like certain other governments that we've seen in the G7, where every day you have to issue debt to honor your social security or your social safety net. So we're good, according to latest estimates for the next 70 years at the pension fund level. And that's really important because you have a lack of discipline from governments on spending, be it in the U.S., most of the G7. So, and the IMF yesterday came out with a study saying, well, the visibility about your so-called fiscal anchors, debt to GDP, they can be off by up to 20% of GDP because of the cycle, which at the same time is exacerbated by an aging population. And then you come up with countries like France, who recently announced that there's going to be a windfall tax on the corporations to make sure that the country is able to stabilize its debt to GDP because, as you know, France is a pay-as-you-go system. That's why their gross and net debt is pretty much the same level. Every day they issue debt to finance their pension funds or public pension funds. So that's a big deal. So from Canada perspective, we don't have to bother about that. So yes, we're going to have some uncertainty going forward, but this is so important because it provides corporations with visibility that we're not going to get hit with a windfall tax, and that brings more stability on our ratings. If you consider that the aging process is taken care of in Canada, not so much elsewhere. So I'm relatively optimistic that with this lack of discipline elsewhere, yeah, we might be negatively impacted on spreads, but not so much because this is key, I think, to stabilize our ratios down the road.
And so down the road. But in the interim, how do you think Canadian companies should be feeling from a confidence perspective, making fundraising decisions, that kind of thing?
I think the ability to be more credible on stabilizing debt to GDP when you have such a net debt advantage is really important. To me, it's critical. So a reliable electricity grid with some visibility on stabilizing debt to GDP means you're less likely to be surprised by these windfall taxes. They are coming, Christine. Mm-hmm. They are coming in many G7 countries. So Canada, I think, is better positioned in the medium term to cope with this.
Okay, well, we're ending on an optimistic note, and I did get you to give me your forecast for next week and for the rest of the year. So I'm going to count that as a win. Thank you so much for your time, Stéfane.
Thank you.
Please welcome to the stage Eric Girard, Minister of Finance of Quebec, for a conversation with Bloomberg's Mathieu Dion.
Bonjour, Eric Girard. It's great to have you here this year. Thank you for being there and attending this event. A few data points before we start, and I don't want to sound pessimistic here about Quebec's economy, but the outlook has been better. Quebec should end its fiscal year with one of the deepest deficits in Canada at $11 billion. Growth in Quebec in 2024 is expected to remain below 1%. I just talked about the deficit here, and at the beginning of 2024, it was much lower than that. Actually, $11 billion is $8 billion more than expected. What happened?
Okay, so first of all, it's a pleasure to be here. The Quebec economy is diversified and it is strong, and our public finances are solid. We have the most conservative definition of deficit in Canada. If you look at the traditional deficit definition, revenues minus expense, the deficit was $8.8 billion. 1.5% of GDP. BC was at 2, Ontario was at 1. It's more than we wanted. we're assuming our responsibility, we'll take care of it, we'll go back to balance within 5 years. Why did we have a larger deficit? 5 reasons. First of all, growth was slow. The Quebec economy in 2003 was almost stagnant. The monetary policy did bite. Second, interest rates were high and we're a large borrower. Third, people in New York City will remember that Quebec had very important forest fire in 2023. We had smoke all the way up to New York City. And this impacted not only the forest industry, but also hydroelectricity production. And this reduced our revenue from Hydro-Québec by $1.5 billion in 23 and 24. And 2 more things that are more cyclical. First of all, we reduce personal income tax in order to protect the purchasing power of Quebecers. And this is probably the policy that prevented the stagnation from a recession in 2023. So good policy. Quebec citizens are highly taxed. We reduce personal income tax. And finally, there's nothing that we can achieve in healthcare and education without people. So we had to pay unions, public sector workers, 17.4% for the next 5 years. We have an agreement for the next 5 years, so we'll have stability in our expenses. And combine this extra expense for public sector employees, there was the population growth, which Stéfane just talked about, that raised the expenses significantly. When you forecast less than 1% growth in population and the actual population growth is around 2.6%, then you have more expenses.
But you still have recurring structural deficits of $4 billion until 2029. How do you manage that? You'll have to make some difficult decisions at what point?
Yeah, again, the $4 billion is after contributing more than $2 billion to the generation fund. So
that's a choice.
Yeah, but so we're committed to reducing debt over time, going to 30% by 30% net debt to GDP. By 2037. So it's our choice to contribute to the Generation Fund. We're committed to the Generation Fund. We'll keep, but the size of the Quebec economy is $600 billion Canadian. So a deficit of $3 billion structural is 0.5% of GDP. So it's manageable. We recognize it. We have a clear plan. We'll go back to balance within 5 years. It's very important.
Where do you find money there, though?
Okay.
You need to cut on expenses.
So if you look, we take a lot of pride in our budgetary documents. If you look at the financial framework document, the pages, we try to answer the very important question. Do we have a revenue problem or do we have an expense problem? Where are we versus where we are before, where we were before the pandemic? And quite clearly, and what I'm going to say here is not very controversial, but it's quite clearly a lot of the expenses that we call temporary during COVID ended up being permanent. So we had to pay premium for employees in the healthcare sector. We had to keep PPE equipment. Now the pandemic is behind us, but these expenses remain. So our expense level with respect to GDP is higher than pre-pandemic, and that's where most of the effort will need to come from in order for going back to balance within 5 years.
How do you find productivity within the public workforce? Maybe to get some synergies and more money out of it.
Oh, that's a very important point, because if you read The Economist, the Financial Times, you'll all hear that the private corporations are not investing enough and that Canada is not productive enough. And that's true, but the public sector is a very important part of the Canadian economy, and the public sector must be more productive. And so that's why we have reform in the healthcare sector. That's why we have reform. And the most important thing that a public government can do is invest in public education. And so we need to be more productive, especially in education, higher education, and healthcare. Transportation also.
To pay for this year's deficit, you went on a borrowing spree. You're issuing more than $36 billion of debt this fiscal year. Why are you laughing? Because I'm coming back
because
to the deficit again, right?
I'm laughing
Okay.
at your term, a borrowing spree, but keep going.
There was no credit downgrade, but there was a warning from credit agencies.
There was no warning, but keep going.
Well, they said they had some concerns there.
There was no concern. Keep going.
Well, I can quote you an article that I wrote where we had, I think it was S&P.
But you're not a rating agency.
Okay, yeah, I'm not. What do you say to investors to reassure them in the face of...
Okay, so first of all, our financing program is $30 billion on average. We're a frequent issuer. We have an 11-year weighted average maturity. We do 80% fixed, 20% variable, 75% domestic, 25% foreign. We swap everything back into Canadian dollar. And we like to be frequent issuer, at least have a curve. Initially, we like to do a 5 and a 10 in euro and in US. With respect to rating agencies, all of them, our outlook is stable. They've confirmed that our plan to reduce debt and going back to deficit is the right one, that this government is committed to doing so. And of course, the deficit of 1.5% of GDP is too much. We're going to take care of it. Of course, we have a large infrastructure plan because there are important needs. One of the things that is not talked about enough about population growth is the pressure it creates on infrastructure. We are building new schools for the population growth. We have healthcare demand related to this population growth. So we have a large infrastructure plan, and we will keep investing in our public infrastructure because we need to raise productivity. But that impose on us the responsibility of balancing the budget.
If there was an election today in Canada, odds are that the Conservatives would win the election and they would come in, and highly probable that they would slash the carbon sales tax. Quebec has its own sales tax, its own carbon tax. Where would that leave Quebecers if the rest of Canada doesn't have a carbon tax?
Okay.
And Quebec has a carbon tax.
So we have a carbon exchange with California. Canada is an energy-producing country. We have responsibilities. We have responsibility today to reduce carbon emission. We have responsibilities for future generation. So Quebec intends to keep its carbon exchange with California, and we welcome any provinces or state that would like to join this exchange. And with respect to the carbon tax in Canada, I think the consumption carbon tax is really what everybody's talking about. And of course, it can be reform or improve or cancel according to the official position. But I think it's very important that we keep the industrial backstop. The objective of having a carbon tax on industrial emission, I think, needs to remain and is important for the competitiveness of Canada, for its long-term commitment to global warming.
And could Quebec remain competitive if there's no carbon tax in the rest of Canada?
Well, the point of an exchange is to make the reduction where it is marginally the most efficient. So that's why it would be more interesting if there were more states and provinces in the exchange.
The federal government decided to tax Canadian companies on 2/3 of their capital gains.
Yes.
Up from half before June. You decided to match or harmonize the new federal rules, hoping to get as much as $3 billion over 5 years. I'm correct saying that. National Bank CEO completely disagrees with this, saying that it will hurt Canada's productivity in the long term, this new rule. Do you agree or disagree with this point of view?
Well, bank CEOs have a very important job, and they're not elected officials. And we just spent the first few minutes of this interview speaking about the importance of balancing budget and having long-term commitment to fiscal balance. The inclusion rate in Canada has always been between 50 and 75%. It's now going to be 66%. It's reasonable. The highest marginal personal income tax in Quebec or in Canada is at 53.3%. dividend are taxed at 40%, and capital gains were at 26.5%, and now they're going to be closer to 35%. So overall, it's a reasonable policy to generate revenues. When you have an imbalance between revenues and expense, there's no easy choices. Some people can say that they don't want this tax to be increased, but I think they have the responsibility to suggest which other tax they would raise.
But could it impact the productivity on the long term?
I think investment decisions are not based on taxation. They're based on the economic potential, and Canada has fantastic potential. We're embedded with natural resource, with great universities, with human capital. And so there are great, we have access to, for Quebec, for example, we have access to 1.5 billion people market. So investment decisions are not based on the taxation rate at the end of a project. They may be influenced at the margin by this, but good project will still go ahead and should go ahead.
There's a lot of talks right now in Quebec about Nordvolt, the Swedish EV battery maker. The company is facing a cash crunch right now. The word bankruptcy comes sometimes when we talk about Nordvolt. There's a risk there. You promised to lend as much as $1.4 billion. Some of it could be converted into equity. Are you concerned right now? Could you hold the further disbursements? Could you put in more money?
Well, okay, so Quebec has critical mineral. We have nickel, we have magnesium, we have lithium, and so we want to transform these, and then we want to produce battery component. And Nordvolt is at the end of the supply chain. So up to now, we have $16 billion of private investment committed. And the way it usually works is, and I'm going to do a generalization, every deal is different, but capital spending is subsidized in the order of 25% by the provincial government and 25% by the federal government. The private investor puts 50%. Okay? So Nordvolt would be the largest private investment in the history of Quebec. It's a high potential project with some risk. We've recognized that when we went ahead. The disbursement are going to go as long as the project advances, and they're committed to their access. It's very important for them. It's their access to the North American market. They want to produce clean battery component with hydroelectricity. So they're committed to this project. The company is facing some challenges, and they're dealing with them, and we hope the project goes through.
Eric, you're responsible for bringing back the Nordiques in Quebec City. Some will say, if there are some Quebecers in the room, that not so many people are optimistic about this. What NHL's Commissioner Gary Bettman doesn't get here?
I wouldn't put the onus on Gary Bettman. I'd put the onus on private citizen or private corporation from Quebec. We have a fantastic infrastructure in Quebec City, a hockey arena that was built with public money, and it is built for Major League Hockey. And so we have the history, we have the fan, we have the infrastructure. We don't have the hockey team. Until we have the hockey team, we want to have world event like the World Juniors, the World Women's Championship. We want to have regular season game. We want to have preseason camps. And so what we need is a private corporation or the owner of a private corporation to come up with a business plan and a term sheet and to give that to Gary Bettman, a bit, and Bill Daly, a bit like Salt Lake City owners did. And once private money is committed to bringing a team back in Quebec City, when it will happen.
It's all about money. Thank you, Eric Girard. Thank you very much.
Merci beaucoup.
Please welcome to the stage Isabelle Laurent, Deputy Treasurer and Head of Funding at the European Bank for Reconstruction and Development, and Elizabeth Wallace, Senior Manager, Funding and Foreign Exchange at the Ontario Financing Authority, for a conversation with Bloomberg's Melissa Shin.
Good morning. Thank you so much for joining us today. I'm very happy to be here. So both of your organizations, the European Bank for Reconstruction and Development and the Ontario Financing Authority, have had a good year, I think. Some issuances have come. I know dozens from the EBRD, including a €1 billion 7-year bond that was issued in July. And then earlier this month, the Ontario issued a 30-year green bond. So congratulations.
Thank you.
And of course, both of you have also been in the green bond space for many years. So I'm curious to know, how has the market for green bonds changed over time? And Elizabeth, we'll start with you.
Okay. I would say that what we've really seen is a maturing and a sophistication coming into the market over the 10 years that I've been involved. It's also a sense of consistency in terms of what the market is and what it is not. And those are things that have evolved over time. And I use this analogy, if you've ever had kids that have learned how to play soccer, you show up when they're 4, 5, 6 years old, and they learn 2 rules, which is don't touch the ball with your hands, and don't grab other kids. Like, don't grab them as they run by you. 2 rules. And I think, and then you look at, a league match, and you see so many rules and cards flying, and everyone's got an opinion on how those rules are being applied, but you have just a plethora of rules. And I would say for the green bond market 10 years ago, you had a few rules to just kind of get everything started and put a little bit of structure around. And as time has gone on, you've got a lot more of that infrastructure in place. So you have green bond principles, you have taxonomies, you have regulations. And that's really been, I think, over that 10-year span, what is most notable is the things that support the market have been built out, and they've been built out in a thoughtful way and in a sort of timely way, so they haven't collapsed the market with the weight of them. They've been brought on as and when needed, and I suspect that that is something that we'll see continue, that sort of continuous learning about what's going to work best in this space and put together something that supports issuers, investors, and the market as a whole.
Okay, I'll think about that the next time I watch a soccer game. And Isabel, how do you see the evolution over your time in the industry?
Well, I think I like the analogy. I also like the degree of optimism. We've been issuing green bonds since 2010, so we predated the green bond principles, and in so doing, we actually followed essentially what they were doing. And there have been, there's been a broadening, there's been a depth to the market, there's been global aspects to the market. I suppose my concerns are a bit, I'm cautious on the degree to which we're imposing rules and regulations on top, often conflicting, often with less understanding about what markets need. So the principles, the green bond principles, really said, if you're transparent about what you're issuing, how you're selecting, how you manage proceeds, and allocate those proceeds, and ideally impact report, then it's up to somebody else to determine whether this is a good product or not a good product. And that, to me, works beautifully, because as long as we've got a good dialogue internally within organizations and externally to investors and underwriters and, index providers and, all the sort of myriad of people that surround the markets, then it seems to me a very good place to start. And it allows people to come into the market, progressively learn, and then become, more in depth. And what I feel at the moment is a concern is the expectation is so high so quickly as to, yes, you shall impact report immediately, and you need to actually provide all this additional information. And by the way, yesterday I was told the number of taxonomies was in 3 digits. I'd stopped counting at over 30. And many of them conflict and what is and what isn't. And I think that it creates a barrier to not only entrance to the market, new entrants, but actually a barrier to those that are in to continue, because the cost and the challenges of issuing become so much higher than just doing ordinary issuance. And that's my big concern, is how do we avoid loading on costs and problems for people that want to fund green things that simply don't exist, even for people wanting to do brown things, let alone just the norm. So, I think we need to be very careful about exactly what the requirements are, and understanding that we need the global market to move. It can't just be about in one jurisdiction. And, there will be banks that have projects globally, MDBs have projects globally, perhaps slightly easier for you at one level in that your projects are in one place, but you still have global investors.
Yes.
And therefore, they're going to need to report according to some sort of, regional or local regulations. And that is really problematic, because it's simply impossible for us all to provide the information that everybody requires for all the different areas. So slightly more concerned, but I agreed with your analogy, and then just the optimism. I was trying to get on board and wondering if it was jet lag or something.
If I can just add to what Isabel was saying, I think one of the things that was most interesting to me in the early days of this market was that the green bond principles were principles. There was a lot of dialogue around, should they be rules, should they be, and the idea of having principles and guidelines, I think, is something that helps direct people in the right way without perhaps handcuffing them. Which I think is your point, is it getting overwhelming so that it's actually a deterrent instead of something that's supporting the market?
And I think it's partly because it's so difficult to say in a given context, is this green enough, good enough? What is the baseline we're comparing it to? What do we need? How do we crowd all the different people in that we want to crowd in? So it can't just be about doing lots of new renewable energy things in, near zero, net zero jurisdictions. We need to get everything moving. And unless we're doing that, we're really failing the promise of the green bond market of trying to help the transition to the Paris Agreement for all the sectors and in all the geographies in which we need to do it. And if it's about just transparency of information, you get to decide. So, a fund manager sitting here or in North America could say, yes, I consider that this is what's needed in this jurisdiction. It's enough, but I would demand something more in another jurisdiction, or less.
Yeah, and I guess the challenge with that is it does put a lot on the investor to kind of have those standards for themselves. And I guess the other side of it is the challenge of greenwashing. If you have sort of flexible standards or flexible rules, how do you guard against that?
Well, I think greenwashing is massively overstated. So most of the time, if by greenwashing we're talking about something that we say is flagged as being green and is absolutely not green, that I don't really see. What we have seen is where people say, well, actually, you've just done the equivalent of, for instance, change your freezer to the next more efficient one, or your car to the next more efficient one, rather than taking the leap to something else, or boiler. So, as in, just business as usual and just making sort of slight improvements where you could be going further. And we've had what we've started referring to as sort of contextual inconsistency. So where you end up with, say, a very high emitter doing a very good green project, But they haven't explained how this is consistent with their overall business strategy so that everything is moving in the right direction. It's not just some sort of nice flag, little advertising thing on the side. And that we can do by explaining context and giving direction through impact reporting and more information as to what's ambitious enough. We don't need to start killing things and stopping people getting going, which is the problem. And, you know, I'm not applauding anything going through that would be sort of considered greenwashing, but outright greenwashing, we simply aren't seeing in the markets. And I think the dialogue and the transparency requirements really fight against that.
That's comforting. What are your thoughts, Elizabeth?
I've been listening fascinated to Isabel's comments on this. It's one of those areas that, I mean, you live in fear of it as an issuer, that someone will point to you and say that's greenwashing, because it's your reputation is part of what you're using to issue, part of the platform you're issuing from. And again, we just don't have a lot of clarity in terms of what is greenwashing. And I think there's those sort of standalone projects in an organization that is not really moving the dial at all, but is sort of throwing a crumb to say, oh no, but look over here. We're doing all of this over here that you won't like, but we have this piece. Focus on this little piece over here. And I think that you don't want to see that in the markets at all. But yeah, I haven't come across a lot of it myself, but I heard a lot of talk about it in the same way you're referencing, where really it's almost, fear-mongering isn't the right term because it's not at that level, but it's that kind of, yeah, it can be quite a deterrent, especially for a new issuer. Reputation is everything as an issuer, so you're always wanting to protect that. And anything that might call that into question, I think, is going to limit your enthusiasm for getting into this space.
Sure.
And I think sometimes they're asking for data that simply makes no sense, you know, as though it were a sort of greenwashing thing. So they would, you can see in Europe, for instance, they're asking a lot about carbon footprint. All carbon footprint tells you is where you are now. It's the externality of where you are now. And they may go on to ask you for your water footprint or your nature footprint or something else. But it tells you where you are now. It doesn't tell you whether the impact of what you're investing in to try and make changes is really going to achieve that. And if you're a bank and you're really trying to help the hard-to-abate sector, and including in emerging markets, and you're really trying to help transition, then you're, in the interim, your carbon footprint's likely to go up because you're going to be lending to people that are the harder ones. It doesn't mean that they're greenwashing. It doesn't, as fund managers, as portfolios, as anything. It just means that they're trying to crowd in things that are meaningful, that we need to see move forward. And we can't just be doing things that...
Easy, low-hanging, yeah.
Exactly. And also in a slightly blinkered way, because, you know, it's not like your green card isn't made of metal and glass and other things, which are all the difficult bits. And then, you know, let's not think about how they're made or the mining, you know. So I think we need to be more inclusive in that sense and more thoughtful and not too knee-jerk and prescriptive.
Got it. So I'm hearing that the market forces, reputational, you know, the due diligence that's necessary anyway, will sort of mitigate some of those challenges with regard to greenwashing. Okay, that makes sense. You mentioned earlier the taxonomies and the regulation. Canada last week released guidelines for the taxonomy that it will eventually create. A third party is going to do it, so we don't know exactly what it will be yet. And that adds to one of, I believe, 42 that are either in development or have been released. So there's lots around the world. You mentioned the inconsistencies as well. There's also securities regulations, and various groups have put out their version of what is green. How the heck do you manage all that? So yeah, Elizabeth, what are your thoughts?
From our side, I mean, we can't manage all that. At its base case, when we came into this program and what we continue to do with it is our best with the material we have, with the information we have, with the situation we're in as a province, and we're trying to move the dial. There's only so much we can do realistically. And so I think we just have to know our lane, understand it fully, and try and keep moving forward in it. I can't tell another issuer how to do it better for them. I can only look at my own situation and what's going on within Ontario, the projects we have. The reputational thing is a bit of a problem in as much as governments are very focused on their reputation. It's how voters vote is based on who they think is most credible in the space. So it's one of those things where as you layer on all these different ideas about how to sort of structure the market, you in many ways are frightening away some really good projects that we have in the province, et cetera, because they hear things and they're like, oh, but there's a regulation, there's a this, there's a, does this fit within the taxonomy? Oh, because I thought we had to fit within the framework you have, now it's something different. The second party opinion provider we had said something, is that no longer true? Because as Isabel says, it conflicts now with the taxonomy. Like it just becomes this whirling sort of, there's a lot of momentum to the information, just swirling and nothing landing and nothing really feeling like you can say for sure that that's how it should be interpreted. So I think when you're in that space, it makes things almost more difficult rather than easier, which I think was the overall concept to begin with, was let's provide a roadmap for people, put things in boxes that they can understand and they can decide if they want to buy something in box A, box B, box C. And now instead we have box A, box A1, box A2, and it's just, I think it's adding confusion. And so I think it would be really nice to see some consolidation actually in that space, maybe a broader look instead of a more detailed look, and then have investors decide for themselves. Because again, contextually, they know what their motivations are, they know what they're trying to achieve. I think they could probably, with just some basic bare bones structure, understand where it is they want to be participating and where it is they want to avoid.
Yeah. And Isabel, what is your advice for investors navigating this many varied area?
Well, I think, dialogue is everything. So trying to listen to issuers, have a dialogue, explain what they will do, what they won't do, how they think about it, and we can all learn from each other, and we can keep pushing forward, and not to make the perfect the enemy of the good, that we really need to work together to try and move the whole sector forward and perform the function that the green bond market is trying to do. And I completely agree with everything you said.
Oh, thank you.
Well, that's a great place to end. Thank you so much to both of you, and thanks all of you.
Thank you. Thank you.
Please welcome to the stage Ian Charest, Vice President, Treasury at CDPQ, and Audrey Gaspar, Senior Managing Director, Treasury at Ontario Teachers Pension Plan, for a conversation with Bloomberg's Leanne O'Day.
Good morning, everyone. Great to be speaking with you, Audrey and Ian. Thank you for being here. Before we delve into funding requirements and bond issuances, why don't we start by you talking about your roles at your organizations? Would you like to go first, Audrey?
Sure. So I'm the head of Treasury at the Ontario Teachers Pension Plan, responsible for all capital raising, liquidity management, and maybe just a couple of words about Ontario teachers. So we are a defined benefit pension plan. We are responsible for investing the plan assets really to meet that pension obligation for all the public school teachers in the province of Ontario. And that's about 340,000 active and working teachers. Supporting that pension, we've got about $256 billion in assets under management as of June 30th this year. So really a sizable pension plan and a large accountability set. So when we think about sort of my role as head of Treasury, I sit inside that total fund management group, and I call that out because we really think about our bond issuance program and our Treasury function aligned with the total portfolio construction of the portfolio from a top-down standpoint. So maybe it's just a bit of flavor in terms of sort of my role and how I sort of fit into the total fund.
Well, thank you for having me first. A pleasure. And yeah, similar to Audrey, I'm in charge of the Treasury team. Our mission is threefold. We develop, maintain funding programs for CDPQ. We manage liquidity reserves, so CDPQ's basic liquidity reserves to cover various needs, including during a severe market downturn. And we act as an internal banker, so we support our various business units to basically optimize their investment strategies. As for maybe a word on CDPQ, we were actually created by the government in 1965 to manage funds for public and parapublic organization in Quebec and in the province of Quebec only. So the majority of funds we manage come from pension plans of public sector employees in Quebec. It'll be teachers, healthcare workers, and public servants. And these clients of ours, we have 48 institutional clients. They are, for the vast majority at least, required to work with CDPQ as their sole asset manager. We have an exclusive legislated mandate. And we also act independently from the government. So we were created by the government of Quebec, but we're fully independent. So there's no political influence. We work for our clients, not directly for the government.
But why do pension plans or pension fund managers such as CDPQ tap the bond market? How does it fit into the overall investment strategy?
Well, I think that there's two main reasons. The first one is actually because these funding programs provide more options as a large, sophisticated investors having access to these funds allows us to diversify a little bit more our portfolio, change the asset mix to provide the optimal expected return for our clients. So it's not about increasing risk. We're not using these funding sources to add leverage on an existing portfolio. That's not it. Our clients have a very specific established level of risk they want to take. That's a given, and then we use funding to optimize portfolio construction. And then the second reason is really to give us more agility in deploying capital and managing our liquidity reserve.
Yeah, so very similar. I think, as I mentioned, at Ontario Teachers, we look at the total portfolio from a top-down standpoint. So we have a single client, just the school teachers in the province of Ontario, that we have a fiduciary duty to. And so when we think about our portfolio, it really has a top-down view in terms of, what is the optimal risk-reward profile we want in our portfolio. So we're looking to deliver the sufficient return to keep that pension sustainable over the long term, but with the least amount of risk as possible. And so diversification is a core part of how we think about that portfolio construction, and our bond issuance program feeds into that optimal portfolio construction. So we're able to de-risk the portfolio essentially while earning that same return that we need to meet that pension obligation.
So both CDPQ and OTPP issue $1 billion of bonds every year. How's the investor appetite for both your bonds, Audrey?
Yeah, so I would say, our first inaugural issuance was back in 2017, and we've been in the market annually since that point in time, and our program has grown quite a bit in the last 5 to 10 years. And so really, who's looking at our bonds? We have an abundance of central banks, official institutions. We have asset managers, institutional investors. We have bank treasuries, just to name a few of the investors that really are underlying sort of the bond investors for our program. But when I take a step back and say, well, what's the credit appeal for example, Ontario Teachers? At the core of it, at the front end, the creditor priority sits with bondholders, first and foremost. So when you think just about creditor priority from a default standpoint, the bondholders stand way ahead of the pensioners, and so that's a part of the design. So just that robustness from a creditor priority standpoint. Like Ian said, Ontario Teachers is also an independent organization. So Ontario government is one of the plan sponsors to the plan. The Ontario Teachers Federation is the other plan sponsor. But we operate by design. We were set up to be completely independent. And so we're overseeing the portfolio. We're overseeing really how to invest to meet those pension obligations, and so that independence really sort of feeds into it as well. When I take a step back, we're also really overseen by an independent board that sort of really comes back to that independence function. And so, when you think about good governance, good risk management, really in the vein of sort of delivering against that pension promise, there's a robustness in the funding side from a pension plan standpoint, but then also from just an investment management standpoint, and just a sizable pool of assets that really backstop that as well.
Ian, would you like to tell us about...
Well, I won't repeat everything what Audrey said, because we have obviously similarities. At the end of the day, I think we offer exceptional value for investors. I may be a little bit biased, but not that much. I think we've been rated AAA from the beginning of our first issuances back in the early 2000s, but we launched our current funding program in 2019, and we were able to, as Audrey mentioned, we're able to expand our investor base. We now have a pretty well-diversified investor base across investor type, across region. That's because investors recognize that value. And that AAA rating, again, similar to Ontario Teachers, there's, of course, like structural, legal reasons, legal protections for senior creditors, priority of claim for senior creditors, independence from the government as well. And for us, one key aspect, obviously, as an asset manager, we're not a pension plan per se, we're an asset manager, but our clients have an exclusive legislated obligation to invest their fund with CDPQ. So that's the legal, structural part. And of course, we operate in a very stable legal environment in Canada. And as for the financial coverage of things, we will always maintain a very low level of senior leverage. Today, we have roughly something around 8% of our assets that are funded with our senior program. Of course, the vast majority is funded with our clients' capital. So that coverage will stay at a very high level at all time. And there's also the quality and liquidity of that coverage. So we have a very well-diversified portfolio across asset classes, across regions, and there's a significant portion of that portfolio that is maintained in very liquid assets. That summarizes roughly why I think we offer exceptional value for investors.
Audrey, can you talk a bit about the core strategy around issuances for Ontario Teachers, and what markets do you usually tap?
Yeah, so as I mentioned, as we think about the total portfolio, so the issuance sort of feeds into the portfolio construction. It also sort of will feed into how we think about currency management as well as interest rate management. So as we look at that total portfolio approach, the bond issuance sort of feeds into that. So we get a value in terms of certain currency hedging properties as well as interest rate standpoint. But I say when we think about sort of going to the market, we've built out a curve in the US dollar. That was the first market that we sort of built out our curve, and then we moved into the euro market. So we're really a global investor that is supported through a global issuance program as well. More recently, we've put our focus into Canada, and so if we think about sort of the areas of our focus, it's about being a regular issue in these markets and having a presence in the US, Euro, as well as Canada. On the margin, there's also the sterling market where we have issued bonds as well as the potential for Australian dollar as well. And when I think about sort of how we think about our bonds, we do issue conventional bonds as well as green bonds. We do have 4 green bonds outstanding, 2 in the European market and 2 in Canadian dollars.
Roughly speaking, as I think about sort of just broadly, we tend to issue benchmark-sized bonds in these markets. We're really looking to the primary market to provide liquidity to our investors, and so we tend in each of the markets issue in that benchmark size form.
What markets do you focus on?
Well, it's not too dissimilar to Ontario Teachers. We launched our funding program in 2019, and it was clear for us that we had to focus on core markets to make sure we develop a large investor base and commit to these markets with regular benchmark issuances and provide predictability and stability to investors and building liquidity and a proper yield curve. So that meant for us maintaining that focus. So that will be mainly the US dollar market, Canadian dollar market, and the euro market. That's the main focus. That does not mean that we will not issue in other currencies, of course. Diversification of investors is very important. So whether it's Australian dollars or sterling, for example, that's things we will look at. And we will grow, obviously. So with that growth comes a need to continue looking at other markets. So that would say that's the main part of our core strategy. And we'll keep, again, as a long-term objective, the market itself. We're not arbitrageurs. We're not looking at making the last basis point when we issue debt. We're really looking at things with a long-term view.
Okay. There was a notable surge in bond issuances this year in general. OTPP raised around 3 billion Canadian, CDPQ raised around 4 billion USD. Both are a bit lower than last year. Why is that for CDPQ?
Well, if I speak for CDPQ, well, yes, you're right. We issued a little less than last year. If you look at the last 3 years, we're pretty stable. I forgot to mention that we have a target that is roughly around 6 billion of issuance a year. That's in US dollars. That's an average. Obviously, we'll have to issue more or less depending on their circumstances. But 6 billion is our target. So we've issued around that amount in the last 3 years. But it really depends on the circumstances. If you look at the general pension issuer space, again, you'll see a lot of stability in the last three years, something around 25 billion of issuance. And I'm not very surprised to see that stability because we share a common goals. We, commit to investors with stability and regular issuances. And we use funding as a long-term strategic tool. So that's why I think you should expect that stability on this market.
Yeah, I would say for Ontario Teachers is probably in line. I would say when we started the program, and in 2020 and 2021, we would have, done a larger amount of issuance, really starting up that program and really maturing it and building out the curves in the multiple markets, as I mentioned. And so where we are today is more in that mature phase. And so I think what you'll start to see, to Ian's point, is just more stability in terms of our issuance patterns and what we do anticipate on a go-forward basis. The one thing to note is that on any one year, it might ebb and flow a little bit, and from the Ontario Teachers' perspective, that will be a function of sort of how the portfolio needs change, and we do an annual exercise really to review what is the capital envelope that is required for the investment program on a go-forward basis. And so you might see a little bit of ebb and flow, but definitely we have mature programs now in place, and there's a desire to sort of constantly be in the market in sort of maintaining those programs.
How do interest rates movements impact your funding needs, particularly as the Federal Reserve moved from hiking to cutting? Ian, you can.
I think simple answer for me will be not much, because our funding needs are, again, a long-term strategic tool for us, and our clients have a long-term investment horizon. So the trajectory of interest rates, it will not significantly impact in the foreseeable future, at least, the funding needs. Of course, that will impact, if there's high volatility, that can impact investors' appetite and impact our timing of issuance, obviously, but from a strategic standpoint, I don't expect much impact there.
Audrey, what considerations do you have for maturity choices and currency mix?
So, as I mentioned, we are a global investor and we have a global portfolio, and so that will feed into sort of the desired currencies that we would want to issue in as well. There's a natural currency hedge that comes with issuing globally because we do have that natural currency exposure, which has a value proposition for us internally, even though the market might not see that, and so that will feed into sort of how we think about it. But fundamentally, you know, we have three core markets that we want to have a presence in: the U.S. dollar, euro, and CAD. And so we will take that into account as a part of our funding plans to ensure that we are in the primary market in these markets to really provide that primary liquidity for investors. That said, market pricing does feed into the ultimate decision, and market conditions at the time will feed into that. But as we sort of take that longer term view in terms of how we want to access the market, it really will feed into the synergies that we have from a total portfolio standpoint, as well as just from the benefits that we have to be in those markets, just to ensure that we have that presence.
Thank you so much for your time.
Thank you.
Well, thank you very much.
And now I'd like to welcome to the stage Tariye Gbadegesin, the CEO of Climate Investment Funds. Thank you for being with us. Tariye leads one of the world's largest multilateral funds with over $12 billion pledged. The fund helps low and middle-income countries adapt to and mitigate climate change. Tariye, can you talk more about what SIF does, and also a little bit about your experience leading up to this role?
Thank you so much for having me. It's great to be here. The Climate Investment Funds is a really interesting and exciting organization, established in 2008 by the G7 and the G20, responding to a call for accelerating clean technology, innovative technologies to drive climate ambition. And it was very much designed to work exclusively with the multilateral development banks, driving their activity in clean technology. And if you can take a step back, 2008, solar projects, wind, these were barely investable, if at all. And the whole idea then was that these are 5 years out, 10 years out. And the SIF's funding was put forward as a catalytic concessional base to drive multilateral development bank financing of advanced technologies, and to do so by also mobilizing additional funds. So the SIF specializes in high-risk concessional funding to drive climate ambition. We are comprised of a couple funds. So we have, like you mentioned, we have $12 billion of commitments. A large part of our business is the Clean Technology Fund, which is about $6 billion, and that is dedicated to energy system transformation work. So clean technologies, battery storage, renewable energy integration, accelerating coal transition, and we're actually going into industrial decarbonization. The other side of our business, the Strategic Climate Fund, does more around forestry, resilience, and hard-to-finance areas. All in all, it's really about pioneering, about innovation, and sort of driving the advancement of new ideas, new technologies for climate action today.
Are there specific climate challenges that you address through your funding, and what sorts of challenges do you face when you help countries transition?
Sure. I like to sort of double click into the Clean Technology Fund business, which is very much the largest of our operations. Historically, we had been investing in renewable energy. And then as we went through our 16-year trajectory, there was a drive for us to do even more. And we launched the Accelerating Coal Transition Program, a $2.2 billion intervention in supporting countries to accelerate their move away and their close down of coal. Many of you are probably aware of the South African Just Energy Transition Plan. Well, part of the funding from this program, about $500 million, is one of the pieces that goes into that ambitious program. We're very grateful to the Government of Canada as well for being one of the major contributors into that particular program, not only with a $1 billion contribution, but also with a dedicated allocation to women-led coal transitions. And why we talk about transition is that while the accelerating coal transition is very exciting, it's critical. I mean, at the end of the day, if coal emissions were taken together, if they were a country, they would be the largest emitter in the world. And so solving the coal challenge is very central to us halving emissions by 2030 and reaching net zero by 2050. But what stands in the way? The just transition. I mean, without considering the jobs, but not only the jobs in the plants, but the entire economies that surround these systems, you actually aren't going to get there. So that's one of our sort of big interventions. And if you look forward, we're also looking at industrial decarbonization. Last week in Brazil, we launched $1 billion industrial decarbonization program, which is really about those hardest to abate areas. Industry counts for about 25% of emissions. We need to pretty much reduce them by 93%. So we're looking at supporting green steel, green cement, green hydrogen, and the like. So we're always at the cutting edge, really kind of exciting activities, but again, driven through the multilateral development banks.
We know that CIF is planning to launch a capital market mechanism, the first of its kind. How does it work?
Sure. It's, again, very exciting times for the climate investment funds. We are one of the multilateral climate funds, also called MCFs. So there's more alphabet soup coming your way. So we have the multilateral development banks and the MCFs. We are really thrilled that we will be the first multilateral climate fund to tap the capital markets. And why are we able to do this? Because we have a 16-year track record and we have an operational portfolio that is generating reflows. We will be issuing from the Clean Technology Fund asset base because that is the fund that has the loan portfolio to large-scale projects. A lot of the countries that are recipients are middle-income countries. Again, it's a strong contributor base from the G7. I think even up to, we actually have 10 very high-quality contributors that have issued funding into that vehicle. Now, it's important that I highlight what is the objective of the mechanism. First of all, you're all aware of these large numbers, $2.4 trillion per year, that is required for the energy transition. And the numbers just keep getting larger and larger and larger. And the summary of it all is we need a lot of money now, and we need it every year. We all need to get smarter about how we find new sources of funding, make our balance sheets more efficient. There's been a call to the multilateral development banks to do more with their existing portfolios, do more with their balance sheets. We're getting the same. And so we currently have a loan portfolio that is generating reflows. It is actually reflowing funds. And we are using the capital markets to front load those reflows so that we can get that funding into projects today when it's needed most. Really, this is before 2030. And so we are going to be going through an issuance program where we will be sort of raising funds on a regular basis in the capital markets as a way for us to deploy those funding, that funding alongside MDBs to accelerate investments in these sort of challenging areas.
So as you mentioned, there's a massive need for funding for energy transition, but what's the investor appetite like for this kind of funding?
No, it's been very interesting. We've had some really great outings in that, this is, if I can go back to the point that we have 6 dedicated implementing agencies, which are the multilateral development banks, the World Bank, the IFC, the EBRD, Isabelle Laurent is here, good to see you, and the Inter-American Development Bank. We also have the AFDB and the Asia Development Bank. So these are AAA rated MDBs. And so since we fund effectively alongside them, the quality of the book is in line with their standards. We leverage on their systems, their processes, their credit methodologies. It gives us the span and the distribution that is very difficult to replicate. So we're sort of leveraging on that experience. What this means is that we're bringing to market an issuer that is integrating AAA rated MDBs alongside a coalition of donors, the 10 donors, that have particular interests in driving transition. A lot of the market are very excited about bringing a new issuer in this category to the space because we are going to be in this sort of high quality issuing category, and it's not usual, it's not typical that new issuers come to the market in this space. So there's great reception. The other benefit is that it's a pure play clean technology fund, in that all it does is emissions reductive allocation. And so therefore, there is also a lot of excitement that we're having not only a sustainability development focused issuer with the AAA rated banks as part of our implementation framework, but also the fact that it is going to be, clean technology and, sitting squarely within sort of like a pure clean play.
So what are your aspirations then? For this mechanism?
Well, if you, what's been very interesting for me with this role is that, I sort of built my career working on multilateral private sector interventions. And so I've been investing in private equity, working in capital markets, and really looking at how do we solve capital allocation challenges with innovative financial instruments. And it's a very interesting time in the climate finance and the development finance space because you have countries, influential, both recipient countries, donor countries that are saying we need to do more with what we have. There are reducing ODA envelopes. We have to figure out how we can address the capital stack for climate investment and development investing. So what I'm very excited about is by having a capital market mechanism that can effectively answer a lot of the challenges, which is that we need more private funding going into climate. And this is actually going to be a way that private capital can be allocated into a multilateral climate fund and becomes part of the solution. You'd be interested to hear that this year the G20 has dedicated a piece of their work to multilateral climate fund coherence funding. It's not separate from the fact that there are going to be new quantified goals toward funding that will come from the developed countries to developing countries. So if the CIF is doing its bit to bring in funding through the capital market, leveraging on its profile, then we're very much answering that call to introduce private funding, to introduce new mechanisms, to enhance to leverage our balance sheet more. And we need to see a lot more of this, and I expect the other multilateral climate funds to leverage on our experience to do similar.
So since CIF has been around since 2008 and you've done work in over 80 countries, can you talk a bit about some of the projects that you funded?
Sure. And I think that's what's really special about our work is that we're sort of operating at all layers. We're operating at the sort of government's contribution, from the government contribution perspective, recipient country perspectives. We're now going to the capital markets and we're allocating this funding into real projects, real technologies, and really affecting people and their livelihoods. One of the things that makes the CIF different from a lot of the other multilateral climate funds or even the other, organizations is that we invest programmatically. This means that we don't invest sector by sector or even project by project. We want to make sure that the investments we make are going to address both the regulatory environment, policy enhancements that need to be made, project development so that pipeline will be generated, and we fund the assets. And so some of our exciting projects, so for example, I'll speak about Turkey. This is a project that we invested in alongside the EBRD and the World Bank, where the CIF put in about $240 million of concessional funding, mobilized another another billion or so dollars from our partners, and we're able to deploy over 800 megawatts of renewable energy at a time when there was very little investment in renewable energy in Turkey. Now, what's very different about our work is we don't focus on the dollar for dollar. Mobilization targets have always been part of our DNA. For every dollar the CIF puts in, we mobilize another $8 to $10. And so this particular project has been focused on working alongside the MDBs to fund commercial bank activity into renewable energy. And so what that means is that you are effectively coaching or creating an innovation or learning laboratory for the financial system to be able to fund renewable energy. And that way, our catalytic funding can do its work. And when the system is functioning and operating, we can apply our funding elsewhere. And so that's a very successful project. We love talking about it because it really affected the amount of renewable energy that went into that market and catalyzed commercial banking activity in renewable energy in a high impact country. I also like to speak a bit about another one. It's a little country, but it's one of my favorites, which is the Maldives. We did a holistic renewable energy program in the Maldives, and we were able to take their renewable energy from when we started the program from 1% to 24%. And you know, a lot of the islands are so reliant on imports of diesel, even coal, to power the countries. And so the idea that our programmatic approach is not only integrating renewable energy, it's also affecting balance of payments, right? Because you're reducing import bills, you're reducing, a lot of that systemic reliance on an external a source of energy. And what's very exciting about this program, we put in the policy frameworks to be able to enhance, we funded a lot of capacity building and policy support. And even now, the Maldives renewable energy programs are being funded without the CIF. And they're bringing in private sector, and it's just sort of scaling, and you can really see sort of the power of catalytic funding to drive transformational change.
Okay. Thank you so much for your time.
Oh, thank you. It was really great being here. Take care. Thank you so much.
We're going to have a 15-minute break now. Please help yourselves to coffee, water, anything you like right outside that door. And we'll be back in 15 minutes for more conversations. Thank you.
I keep on slipping through you. You want a good man, you want a wedding band. Girl, that's in your hands, cause I keep on slipping through you. Slipping through your fingers, through my hair, you like to braid it. Sleeping on my couch, all in my clothes. Said you want a man just like me, baby. Oh, but I know someone out there pretty close. Cause your mama love me, and your daddy too. Can you please just tell me, girl, what else I gotta do? Why don't you love me? You said I'm funny, guess not enough, babe. Cause I keep on slipping through you. You want a good man, you want a wedding band. Girl, that's in your hands, cause I keep on slipping through you. Slipping through your fingers. I'm slipping through your fingers.
Hey, why you gotta ghost me, leave me on red? I'm the one who's waking up in your bed. I'm the one you brag about to your friends. So why can't I call you my man? No, don't you dare be wasting time. I need you to stay, won't you be mine? Cause your mama loves me, and your daddy too. Can you please just tell me, what else I gotta do?
Why don't you love me? You said I'm funny, guess not enough, babe. Cause I keep on slipping through you. You want a good man, you want a wedding band. Girl, that's in your hands, cause I keep on slipping through you. Slipping through your fingers. I'm slipping through your fingers.
Baby, I'm slipping, 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 slipping through your fingers. Slipping, 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 slipping through your fingers. Come on, baby, I'm slipping, 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 slipping through your fingers. Don't let me go, no, no. Slipping, 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 slipping through your fingers.
Holding me back, gravity's holding me back. I want you to hold out the palm of your hand. Why don't we leave it at that? Nothing to say, and everything gets in the way. Seems you cannot be replaced, and I'm the one who'll stay. Oh, in this world, it's just us. You know it's not the same as it was. In this world, it's just us. You know it's not the same as it was. As it was. As it was. You know it's not the same. Answer the phone. Harry, you're no good alone. Why are you sitting at home on the floor? What kind of pills are you on? Ringing the bell, and nobody's coming to help. Your daddy lives by himself. He just wants to know that you're well. Oh, in this world, it's just us. You know it's not the same as it was. In this world, it's just us. You know it's not the same as it was. As it was. As it was. You know it's not the same. Get hit by speed internet. I don't wanna talk about the way that it was. Leave America to kids follow. I don't wanna talk about us doing it first. it sounds just like a song. I want more berries and that summer feeling. It's so wonderful and warm. Breathe me in, breathe me out. I don't know if I could ever go without. I'm just thinking out loud. I don't know if I could ever go without watermelon sugar high, watermelon sugar high, watermelon sugar high, watermelon sugar high, watermelon sugar. Strawberries on a summer evening. Baby, you're the end.
Please take your seats. The program will begin in 5 minutes. Please take your seats. The program will begin in 5 minutes.
Tastes like strawberries on a summer evening, and it sounds just like a song. I want your belly and that summer feeling. I don't know if I could ever go without watermelon sugar high, 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 watermelon sugar high. I just wanna taste it. I just wanna taste it. Watermelon sugar high. I just wanna taste it. I just wanna taste it. Watermelon sugar high. Watermelon skies while we are racing home. Melted lights cover the open road. I hope you make it, 'cause I've been chasing another odyssey. Oh, I can't wait to see your face crash when we're switching lanes. My love's beyond the pain, but if I miss the break, we're dancing in the flames. It's indescribable.
Please take your seats. The program is about to begin. Please take your seats. The program is about to begin.
Headlights, and you say hold tight, another odyssey. I can't wait to see your face crash when we're switching lanes. My love's beyond the pain, but if I miss the break, we're dancing in the flames. It's indescribable. Everything's fading, we barely made it. The fire's raging, but you're still beautiful, and it's amazing, 'cause I can taste it. Our final odyssey.
Please welcome to the stage David Eyre, Treasurer of the Canada Mortgage and Housing Corporation, Flora Chow, Global Head of Funding at the International Finance Corporation, and Randy Ewell, Senior Funding Officer, Capital Markets at the World Bank, for a conversation with Bloomberg's Paula Sambo.
Hello. Thank you for not leaving us alone here after the break. We were kind of terrified. So to start off, I'd like to hear from all of you, starting with you, David, about your funding program and what makes it different from your colleagues and friends, actually.
Yeah, absolutely. Thanks, Paula. Thanks, obviously, for everybody for being here today. Really appreciate it. I was just saying earlier, it's nice to be back in person at these things. I think coming out of COVID, we all have a new appreciation for getting to actually see people, and so a huge thank you to everybody for being here today, and to Bloomberg. So look, the Canada CMHC program, CMB program, which is the program that we run, is a $60 billion a year funding program, so Canadian dollars only. So not obviously not as interesting as my colleagues here who are issuing in different currencies, but I think still a pretty exciting program in Canada. We're about $265 billion outstanding, so quite a large program by global standards. I think programs played a key role in the mortgage funding market in Canada for quite a few years now, since 2001. So, including, I would say, more recently, from a policy point of view, helping with create affordable mortgage supply for multifamily housing in Canada. So.
Okay. What about you, Flora?
Yes, so first, thank you for having us. IFC is the International Finance Corporation. We are part of the World Bank Group, but we do have a separate funding program, separate balance sheet, and so in terms of size, we issue about $15 billion a year, which is quite smaller than both my colleagues here. But we do issue in various markets across the globe, and Canada is one of our very important markets. Overall, we have about $60 billion outstanding, and as I mentioned, we're about $15 billion per year. In terms of what the funds go to, we ultimately issue the bonds, and the funding goes to private sector companies in emerging markets. And ultimately, we're trying to serve our mission, which is poverty alleviation and increasing income prosperity.
And how is that mission different from yours?
No, well, our mission is the same. It's the same. The difference being, and I represent two issuers as well, and that's IBRD and IDA. IBRD, everybody sort of understands colloquially as the World Bank, been around since 1944, and a big issuer. The funding program's between 50 to 55 billion a year. And IDA is a relatively new entrant into the capital market. Its inaugural was in 2018. IDA was initially set up as a sort of funded through donors, through sovereign donors, and it focuses specifically on the poorest countries, and sort of built up a massive equity, and then eventually sort of wanted to leverage and do more by accessing the capital markets. IDA does some more concessional lending, grants, other things to focus on those needs. But the mission's the same across our institutions.
And could you share with us your strategies for issuing bonds in the Canadian market? And how does the cross-currency basis, asset liability management, and the need for market opportunities play into that? And also, how do you ensure there is liquidity for your product?
All very good questions.
Yeah, so please go ahead.
So our IBRD, our funding program is quite large. So our first goal is to stay, to build as diverse of an investor base as possible. So for IBRD, we issue in anywhere between 20 to 30 currencies a year. All of that gets hedged back to dollar because our balance sheet is managed against dollar. So again, it's a matter of just staying, building as much of an investor base as you can. In Canada, Canada is a very important donor to the World Bank as well, shareholder. We've been quite, I think we can brag a little bit politely that we've been doing benchmark issuances in Canada for about 13 years.
With IBRD?
Yes, IBRD.
IDA is yet to issue a maple bond, right?
That's correct. Not for lack of wanting to. I think the idea is that we want to keep the regulatory treatment between the two exactly the same. So we haven't managed to do that for IDA just yet. But when we can do that, we'll move forward.
Any idea when that could be?
No. I was hoping yesterday or last year, but no. I mean, we're working on a few things. We're just trying to get the exact regulatory treatment. I think, things sometimes the government move quite slowly, and I think that's where we're kind of stuck at the moment. But in terms of the overall program, just being as diverse as possible.
And what about you, Flora? What's your strategy for issuing maple bonds?
It's very similar to IBRD. However, as I mentioned before, our program is much smaller. So we have made an interesting strategic decision to not issue in euros. However, we have issued CAD, and we are committed to Canadian dollar issuing a benchmark at least once every fiscal year. And we have done that since 2018. And so the reason that we've stayed out of euros is that we definitely do our dollar benchmark once a year or twice a year, depending. We have Canadian dollar, Australian dollar, New Zealand dollar, and of course sterling. And because, again, our size is small, we want to make sure we're present in each of those markets regularly. And with that, we can get the investor diversification that we're talking about.
Any specific steps you take to ensure there is liquidity when you do issue?
In Canadian dollars? Yeah, so we, one, I think just laying the groundwork, we do a lot of investor relations in Canada. Arguably, we're very easy to, it's very easy to visit the investors of our neighbors. But by laying out the groundwork, we really then talk to investors and see what the needs are of investors. We do try to maintain a curve. It's not always easy given investor demand and what we need on our balance sheet if we're looking to essentially match the term of our lending program. And so I think, of course, working with the investors, maintaining a curve, but ultimately we do have to be mindful of the cross-currency basis, which you mentioned. Having said that, we have issued Canadian dollar at or above our US dollar curve because of the importance of ensuring that we're frequent in the market or relatively frequent in the market.
What would you like to add?
Look, I'll put my investor hat on for a sec. Obviously, I love when, we love seeing the SSA maples come to market. So, I think it's great for the Canadian market to have that diversity of issuance, especially if the price is right on it. It's even better. Look, with my issuer add-on, I think as folks probably know with the CMB program, we are a very programmatic issuer, so we issue 8 times a year. We don't take an opportunistic view on it. Our view is, look, we do large benchmark issues 8 times a year. We come to market regardless of what's going on in the world. We issued during COVID, we issued during GFC, we've issued during some of the toughest markets globally ever. I think we got a $10 billion deal done during the week Lehman's failed. So I think that was just one of the sort of testaments to how strong this program is globally. And I think, again, from our approach to issuance is we always want to be there, right? So it doesn't necessarily mean we're always going to get the best price, but it's much more important from an overall stability perspective that we are in the market 8 times a year with those large deals.
And I understand that overseas investors' demand has somewhat faded a bit over the last year. How are you dealing with that, and are you seeing any signs of improvement?
Yep, no, great question, Paula. So absolutely, we, as folks probably know, we went through a consultation process last year. It did create some uncertainty around the program. You know, in the end, there was a great decision, I think, was made to obviously keep the program. The program's actually larger than where it had been. So again, we went from 40 billion to 60 billion mortgages funded per year now, so 50% larger. I think what we did see last year, and it wasn't a huge surprise, was with that uncertainty, we saw a dip in our international investor base. So we saw that historically we were around 30-35% of our primary book would go to international accounts. I fell to around 20 last year. First half of the year, we were still pretty slow to recover. I would say we started seeing more accounts coming back in terms of unique names, but the percentage was still quite low. So we were around 20-22%. You know, I'm going to say, honestly, we spoke to our syndicate kind of mid-year point of the year, and we said, look, you know, where the numbers, the international numbers were lower than where we wanted to see them, and you know, I think kudos to our syndicate. In the 2 deals since that, we've actually seen a very nice uptick in our international distribution. So the August 10-year trade, we saw nearly 40%, which was, you know, maybe a bit of an anomaly, but quite good. And even the recent 5-year deal in September, we saw 25%. So we're seeing, you know, the overall percentages coming up, which is great. I think, you know, as we get out and speak with investors, obviously great being in New York this week, speaking to a lot of folks, just, you know, letting people know that, you know, that we are obviously still in business. We're, you know, we haven't changed our approach to how we issue. As I mentioned, you know, 8 times a year, still very programmatic. You know, I think as we're getting that word out, it's starting to show up in the data. So.
And as you said, like, you're very programmatic and you all look to issue very often. So no matter how bad or good things are, you're out there. And how do you navigate, you know, central banks that are not as unsynchronized as we would have hoped? And, you know, your international investor base shrunk a bit. So how do you navigate these markets, and what kind of actions do you take in terms of sizing of the deals or maturity, or, you know, what do you do?
So I think for us, I actually think we're somewhat agnostic on that, as strange as it sounds. And I did sort of allude to it earlier that we really are all about that get to the market 8 times a year. And again, it's obviously I always care about price as an issuer, but we are somewhat agnostic to that. It's much more important that we get to the market. Our syndicate truly works very hard, and I believe the model we use, I think, is quite effective, because the syndicate sales desks work extremely hard to build very strong, robust books. We're generally very predictable in terms of the size of our deals that are coming, so syndicates will build those books in advance. So we're quite comfortable with those levels, and I think we just need to demonstrate to the market that we're going to keep doing that. Nothing's changed.
What about you, Flora?
Yes, so we have a global presence with our funding team. So we have people in Singapore, in London, a person in Japan, and then of course in Washington, D.C. And what we do is basically on a daily basis, we're coordinating and monitoring the various markets to see what makes sense in terms of pricing, investor demand, and the like. And I think what we do is we look at that, but we also look at the needs of our our other side of the balance sheet, our asset side, our RPMs having opportunities to invest the funds that we issue, sits in liquidity before it's dispersed to our clients. And so I think looking internally with our asset side, coordinating amongst the team, we then ultimately look for the best opportunities with what we talked about earlier, with the idea of ensuring that we're still in each market frequently enough to remain liquid and recognized by investors.
The last time you issued was in August 2023, so you haven't issued this fiscal year yet.
That's right.
Does that mean that demand is not quite there yet?
I would say right now it is more of a cross-currency basis. The last time I looked this morning, I think we're probably 5 basis points away on the 5-year point. Last fiscal year, when we did issue our Canadian dollar, it was a green bond. It was $1 billion in size, which was the largest we had ever done at that point, and it was 3-year. And so if we were to look this year, which we are looking, we would potentially look to go a little longer. We do believe that the Canadian market, the investors are very interested in sustainably labeled bonds. So whether it's green or social, that is something we'd absolutely consider as well.
Should we expect any issue over the coming months then? Because your
pressure is on. The pressure is on. No, like I said, we are very much committed. And if it's slightly above our dollar curve, we can live with that. And ultimately, like I said before, we also look at the asset side. If there are assets that can be, our PMs can be investing in, we're looking ultimately at the spread. So yes, I am very hopeful that we will issue this fiscal year.
Should we expect some issuance from one of your two entities as well? In Canadian
we would love to issue in Canadian dollar denominated bonds as much as is feasible, and we've made that a priority. We were able to do a 1.4 billion in January. We've been monitoring since. It's still a little offsides in trying to get that done, but we keep monitoring that. And January always somehow tends to work somehow, so we can certainly look towards that and do as much as we can.
And when you mentioned the international investor demand is getting up there, any kind of specific investors, like region-wise or sort of type of investors that are particularly interested in Canada these days?
Yeah, so look, we've seen the pickup we've seen this year, I would say, has been U.S. based. So obviously, a lot of our friends here in New York, it's been great to see those numbers come back up. I'd say Europe has also been quite good for us this year. So we've seen a really nice resurgence out of Europe. We have done some targeted investor relations into those areas, and I do find that works, right? It's just getting in front of people, particularly the central banks. Often, with sometimes the CAD portfolios, there's you'll have PMs turning over in those fairly regularly. Getting in and talking to the new folks is quite important, and it does deliver orders. So yeah, it's been quite positive on that front.
And would that make any sense for you to issue in different currencies?
So for us, we're strictly Canadian dollars. So we're not set up to issue in any other currencies. We have no intention of issuing in other currencies. I think, at the end of the day, as I said earlier, the policy mandate of this program is to support the Canadian housing finance system, the stability of that, which obviously is a Canadian dollar system. And I think, again, I think that the program's proven to be able to do that fairly efficiently in Canadian dollars. So there's really no need to look at other currencies. And I think, again, from that policy point of view, it's also been extended now to really put a push on with the affordable housing issue in Canada and really trying to fund more multifamily housing. So, if we look at the increase last year that the government gave us, that incremental $20 billion is directed solely towards multifamily housing, which, for anyone that's in Canada, they realize that housing affordability has become a very big issue. So, this program has been doing its small part to certainly help with that.
Please keep up. Talking about supporting the domestic market, how do you see the big Canadian pension funds issuing more and more often in the domestic market? And does that have any influence on your decisions?
Yeah, so I was listening to the panel earlier, and I think a lot of the goals that CDPQ and Ontario's have, it's very similar to ours, right? Investor diversification, and of course the pricing and whatnot. And I think there's enough demand, at least currently, to service all of us. We are, I think, complementary to the pension funds and whatnot, rather than a direct competitor. So I think ultimately with more issuers, it will create more interest in Canadian dollar, in the Canadian dollar market.
How do you see this?
Yeah, I mean, I know it's been the last couple of years, it's been higher, and I kind of expect that to stay pretty static going forward. I don't think that really would affect demand for a maple issuance. I think it's really more just getting the pricing right for us, because I sense that there would be certainly interest if that works for us. So, I don't see it really affecting the demand for an IBRD issuance at all.
What about you?
Yeah, look, we love diversity of issuance in Canada for sure. I think it's great to see the pensions active again. We love seeing the SSAs bring maples. I really think the more of that issuance is happening, it's beneficial for all of us as issuers.
Much has been said about CORA as a floater, and I wanted to hear from you guys. What are your views, and what is the importance of pre-selling bonds to make sure such an issue could actually happen? Yeah, sure.
Yeah, well, I mean, for us, again, part of the diversification story, we like to do as many different instruments as we can. We like to try to be innovative. So a CORA issuance, I think, would be great. I mean, for us, we'd like to sort of lend or show support to these new sort of financial benchmarks. And we did that with dollar SOFR as well. We were the first benchmark issuance in dollar SOFR back in 2018. Today, we've issued about $25 billion of dollar SOFR. And at the beginning, it was very nascent and new, and that's really developed into a pretty significant market now. And so for CORA, I think we'd love to take the same opportunity. I know, we've looked at it, we keep looking at it. I don't see any reason. It would be something, it would be right up our alley to try to support something like that.
So maybe your next issuance could be CORA?
Could be. We'll see.
What about you, Flora?
Yeah, I would say we probably want to walk before we could run. So we do look to our big sister, if you will, to issue the CORA. Having said that, we have seen investor interest when we go to the meetings that we've had, particularly in Canada. There has been interest in CORA. So it's something that we definitely keep an eye on, but I would say it is not immediately in our funding, I guess, options at this point.
Yeah, so CORA for us is, we were fairly heavily involved in the transition. I think we're sort of considered the only regular CORA issuer in Canada, and I think we do take that role quite seriously. I think as folks may or may not have heard, we are going to make a slight change to our program next year, not in terms of necessarily the sizing, but we will likely only do the CORA 2 times per year next year instead of 4 times. So, expect to see, less frequent issuance, but I would say sizing very similar to what we've been doing in total before.
Why this adjustment?
Look, I think it's a function of the order books. We know it is a very specific investor base on it, so we don't generally see a lot of depth in those books, but the investors, those investors do generally show up on those trades. So, try to target larger, more liquid deals. So do that twice a year instead of spreading them out over 4. So just help with the liquidity a little bit, make for a little bit bigger benchmark sizes.
And if I can just add, if we're looking at the current interest rates and the direction they're going in, it could also impact the demand in the product as well.
Okay. Well, the time is shouting at us, so I'd like to thank all of you, and that's it.
Thank you very much.
Please welcome to the stage Kevin Karpyshyn, Senior Manager, Trading and Derivatives Capital Markets for the province of Alberta, and Nicoletta Opria, Assistant Deputy Minister, Treasury Division for the province of Manitoba, for a conversation with Bloomberg's Chun-Si Shu.
Hello, thank you for being here today. We're entering a period of macro volatility with a widening war in the Middle East and elections coming up in the US and in Canada. And many Canadian provinces stepped up borrowing during COVID, and a lot of that debt is maturing in 2025. So that's a lot for borrowers to navigate. Can you each talk a little bit about what you're looking out for in terms of fiscal and funding challenges next year? We'll start with you, Nicoletta.
Thank you for having us here today, and thank you to Bloomberg for organizing this conference and to National Bank for sponsoring. Thank you. Yeah, I mean, since the pandemic, we've been executing borrowing programs in an environment of heightened volatility. At that time, we've made the decision to increase our liquidity level. So we went from holding 3 months of cash on hand to 6 months of cash on hand. We've maintained that strategy, and we keep healthy liquidity levels. What that has allowed us to do is just provided us some flexibility in terms of access to the market. We've seen, what we've seen when we increase the frequency in the domestic market is that it does have an impact on our spreads and our cost of borrowing. So having that flexibility and accessing the market when there is investor demand for our bonds does help with our keeping our spreads stable or maybe even improving, and that has benefited that. In terms of public debt costs, I mean, there's a cost associated with liquidity, but what we've seen in the last couple of years with the yield curve is that it has actually helped us mitigate those costs of higher stock of debt because of the positive of carry that we've been able to get on the higher liquidity levels. I think as we're starting to see a normalization of the yield curve, steeper yield curve, we need to try to balance the need for higher liquidity, which does help us manage our program in such an environment, and balance that with the higher cost of the public debt costs.
Are you?
Well, thank you. So maybe before I get started, we'll do a little bit of an economic backdrop on what's happened in Alberta. And we've just released our first quarter. We now are projecting a surplus of $2.9 billion. That's up from $500 million earlier. So we are seeing generally it is positive. Most of that is due to our increase in energy prices. Our forecast for the budget was 74, now it's 76.5. We've also seen a shrinking of the differential between the WCS and the WTI. Both of those things have added net revenue to us. What we are seeing, though, is there is some challenge that we see. One of it's being the immigration that's occurred, and we're seeing some challenges, some stretches in our programs as we go forward. We also see that next year as well. I think we're forecasting our employment to slightly uptick. I think goes from 6.5 to 7. But now getting back to the borrowing side. So on the borrowing program, as Nicoletta alluded to, I think we all went through this in COVID where, it didn't matter what you did, you just had to get your money in, right? So it was more about that, and we'll deal with it later. Well, here we are 5 years later, right? And for us, our borrowing this year, we had projected borrowing of $19.8 billion, but of that 19.8, 11.6 of it was pre-funding for the 2025, because we had 3 months of intense borrowing that we had April, May, and June of 2025 of $11.6 billion, and we knew that we couldn't fund that all at once. So what we've done is we strategically have been doing that throughout this year. And what we've also created is a debt retirement account, which allows us to match the maturities. It's also been a win just because of the slope of the curve. So it's been a net positive for us. We've been able to do that and still make sure that we have enough money to pay the debt down.
Do you foresee the same level of pre-funding for next year's deficit?
Not us for sure, because we were mostly front loaded for this year. I think next year we're only forecasted at about $5 billion. So yeah.
What about you, Nicoletta? Are there any macro challenges that can throw you off your borrowing program trajectory?
I mean, we're for the next 3 years, we're forecasting of our borrowing program to be in line with or at levels that we've seen in the past few years. So we're forecasting between $5.5 to $6.5 billion. Currently, this year, we're funding a $6.2 billion program. So it is pretty much in line with what we've seen. The program is driven by refinancing, as Kevin mentioned, and also cash requirements to fund the deficit and capital requirements. And the government is, it's a government that's been in power for 1 year. The focus really is on balancing the budget in the first term. So we'll see deficits decreasing. We're forecasting to come to balance in 27, 28. But what we've seen in this past year is on the expenditure side, there's pressures on from the healthcare side. So there's a focus on rebuilding Manitoba healthcare with the focus on retention, focus on collective bargaining agreements. And then we're also seeing pressures on the healthcare side from price and volumes on the pharmacare side. So if we continue to see these pressures in healthcare, that's going to have an impact on our borrowing program. And then on the capital side, we laid out a 5-year capital program in the last budget and focused strategically on key areas of healthcare, housing, and economic investments. There is a cap on debt finance borrowing for the next 5 years. That's $1.7 billion is what we're planning on debt financing. So if inflation once again becomes a concern, that could have an impact on expenditures related to the capital program and impact on our overall borrowing.
I see. Growing portions of your funding have come from overseas this year. Can you explain what's driving that and whether you expect that trend to continue?
So Manitoba has always looked for opportunities to issue in international markets. In past years, we've borrowed as much as 30% of our program in international markets. We do look at the U.S. market as one of our primary international markets, a strategic market for us. So we try to maintain presence by issuing once a year or once every 2 years. This year, we were able to issue a 10-year global debenture. We also have a European and Australian medium-term note programs. Those we've primarily issued private placements. Given the size of our borrowing program, we have not done benchmark aside from Australia, which we did this year. But I think this year with the higher borrowing programs, international borrowings more of a, look at it more strategically and look at it as broadening our investor base, which I think that has a long-term impact on our borrowing program. What we've also seen this year is that arbitrage on a number of currencies, international currencies that we traditionally borrow in, they were all working for us. They were all on side. So we were able to get funding done at levels competitive to the domestic market, provinces in general. For ourselves, we borrow international. Well, the levels are competitive, but I think provinces across the board saw that phenomenon. So it also helps with mitigating the cost of public debt costs when there is a larger borrowing program as well.
Yeah, I understand that's the same situation for Alberta too, that you've been raising more debt overseas.
Yeah, well, so we probably have the most volatile borrowing program of all the provinces. So for us, that really is the first thing that drives it. So what happens is, depending on the size, if it can get done if it can get done domestically, we look there, and we tend to stay with the benchmarks. If it is an elevated borrowing, then our first point of contact next would be the U.S. market. Then we look to the euro market after that, and then all the other kind of currencies fall in place. But as Nicolette alluded to, this year, since I've started, this is the first year that I can think of where every currency, every tenor is close to domestic funding level. So it's made it a lot easier to make those decisions. The other point is, as well, is just due to the size. You know, if you can do a large U.S. benchmark, that's the equivalent of 4 domestic deals. So it buys you time, you know, for your next deal. It buys you space as well. So those are all factors that we consider when we look at it.
How can you maintain a presence in some of these new overseas markets when your borrowing program is shrinking next year?
Well, the reality is it is going to depend on size. If we don't have the size, if it can get all funded domestically, then we would look that way. But it's going to be depending on, you know, if there's a potential increase, then we would look. And like I said, our first choice would always be the U.S. market, and then you go from there.
I see. Canadian pensions have been more active in the debt market, both in Canada and overseas. And that means collaboration, but also competition. And I'm wondering if you've had to negotiate to make space for one another when there's competing funding needs. You know, is the pie big enough for everyone?
Yeah, I think the first concern that we all had is there enough capacity in the domestic markets for the provinces, the pensions, and especially with increased borrowing programs, that was a concern. But we do, you know, there is collaboration. We do talk amongst each other, especially with the provinces aware of what's coming to the market, are able to time our issuance so that we're not all looking to issue at the same time. But I think I've been surprised by the domestic market to how resilient it is, and it's been able to handle the provincial borrowing programs, pensions. I mean, for ourselves, we're 80% funded for the year, so we've been able to manage our program. And I think, you know, on the international side, in terms of pensions, they've done a lot of work internationally. They've issued a lot internationally. And I think they've done a great job of just marketing the Canada brand. And I've been hearing a lot lately about Canada Inc. And I think for ourselves, we were in the Aussie market in July, able to issue a benchmark transaction. That was a first for us. We've issued private placements in that market before. And what we've seen is majority was Japanese investors that were participating in those private placements. With this transaction, we saw much broader investor demand. We've had the Australian domestic investors that participated, Middle Eastern investor, European, and I think the success of that transaction, the broader book that we able to see, in part that's thanks to the work that has been done internationally by the provinces, the pensions, and all of us working together and really promoting that brand.
So what I've seen is, what I think is really good about the Provi market in Canada is that we do have things like a large issuer protocol. Where we do is informally we'll talk to each other to manage that traffic. So we do that domestically, and I think it's worked very well. What's happened now is now with the case of the offshore, you now have started to look at that. So I know, for me, I've done that where I'll reach out if I hear that potentially there's someone coming. I'll reach out and just to get a sense of where they are, because at the end of the day, there's really only probably 5 of us that are really issuing, and we've got 200 days, so we should be able to manage that activity. It's just a spirit to be able to do that. But I think so far we've done a pretty good job.
It's been collaborative. So ESG seems to be losing its luster for many investors, for some investors. But we're seeing some pension funds and provinces coming out with green bond frameworks. And I'm wondering, how does ESG fit into your funding plan? Do you have plans to develop such frameworks? And what do you see as the pitfalls of such programs? Or what are the aspects of ESG that most appeal to you?
So we've had many conversations internally with regards to a formal ESG framework, sustainable bond framework. I think it does require a whole of government approach. There's a lot of work that needs to be done on the reporting side to be done properly and timely basis. So it does require that full of government approach. I think from a borrowing perspective, our concerns as do we have large enough projects, large enough program to be able to issue off a framework on a regular basis to build a curve. So those are the discussions we're having. We also see benefits from having an ESG program, a framework, and that is that it provides investor diversification, broaden the investor base. It allows access to those investors that strictly buy label bonds, also access to those portfolio managers that manage more than one portfolio, and that leads to diversification for our conventional program. So we can see the benefits. There's also concerns there. But I think government by nature implement social programs, look at programs that deal with climate risk and reaching the goals of net zero by 2050. So there's work that is being done. The question is for ourselves is, does it require a formal ESG framework? Do we look at putting out a report on there that touches on the ESG and what is government doing from that perspective? Manitoba 2 weeks ago released the affordable energy plan. While it's not a climate plan or a climate policy, it does work towards the goal of reaching near zero by 2050. And the energy plan, it's based on principle of affordability, Indigenous reconciliation, talks about energy efficiency, jobs, economic development, as well as just security and reliability of the electricity grid. So these are all, I think, components of an ESG framework.
How does it look to Alberta?
So, as Nicola alluded to, we still are evaluating and monitoring, but as of right now, best of my knowledge, we don't have a framework. So, and the other point that she had made as well is the management of second curves. Again, being an infrequent or volatile, issuer just adds complexity to that whole side of it as well. So,
speaking of that, how do you manage the boom and bust cycles of commodities and energy? And we're looking like oil is not doing so hot.
That's a really good question. So what we do is we maintain benchmarks. That's always a priority. There are opportunities to do MTNs if your borrowing's elevated, but for the most part, it's always focusing on the domestic benchmarks, and then as we did this year, then we look to the offshore benchmarks. But it's always benchmarks. We find that's the best route.
Okay. Well, that's less of an issue for Manitoba. It was less reliant on energy. I think that's all. Thank you both.
Thank you.
Please welcome to the stage Ryan Chin, Managing Director, Balance Sheet and Liquidity Management for Healthcare of Ontario Pension Plan, and Brandon Weening, Executive Vice President, Corporate and Capital Markets Finance for OMERS, for a conversation with Bloomberg's Paula Sambo.
Hello again. Right off the bat, why would a pension fund even issue bonds in the first place?
Sure, Paula, thank you for that question right off the bat. We at OMERS, we use leverage prudently to enhance the returns. It's as simple as that. And so we invest across a variety of asset classes, including infrastructure, real estate, private credit. Those lend themselves well to leverage, not only at the asset level, but at the top of the house. And that is our primary reason for using the term notes that I help issue. There are a few other reasons that we do it. They're a little, I would call it secondary. One is the natural hedge. We borrow in foreign currencies, we deploy in those foreign currencies. The other is to help us to deploy into those asset classes. And thirdly, we have a commercial paper program that has short-term floating rate. We will warehouse on that and then look to extend out the term overall.
You run the liquidity pool at Hope. So I'd like to hear from you, how do you do your portfolio construction, and how do buying bonds from other Canadian pension funds come into it?
For sure. Thanks, Paula. Appreciate everyone's attention, and thanks to Bloomberg. So yeah, the fixed income liquidity pool is one of the tools that we use within the overall liquidity management at Hoop. Portfolio construction is effectively the attempt to optimize return within the constraints of risk, as well as you want to optimize, in our case, for the collateral and repo constraints of the securities. So because it's a liquidity portfolio, our focus is on government spread assets, things that have government backing or other high quality instruments in fixed income. So, we do have some modeling that we do, but ultimately it is maximizing return per unit of risk within the constraints that we have as a firm, constraints that we have as a plan. And I think your second question was, how do we use
pension fund bonds?
Debt, yeah. So this is a new asset class for everyone, and I think it's a really exciting one because you have very highly rated entities that are issuing a very limited amount of bonds. It's a structure that we are well aware of as Canadians. It's not foreign to us, and we're comfortable with the credit risk. And I think if you were to say the pension plans in Canada are also among the best in the world, so they have incredible governance, and that also is probably part and parcel of having, for the most part, overfunded or highly funded ratios. So, we're very comfortable with that. We're happy to add it into the portfolio where we see fit. And it also provides us excellent diversification, which is, of course, one of the goals in running a portfolio.
Got it. Brandon, after the very direct first question. So part of your work is the oversight of the funding of OMERS and investor relations as well. So the pension fund not only issues in US dollars, it has issued in Canadian dollars, it has issued in euros, and just last week in Australian dollars.
Correct.
So how do you, what do you factor in when deciding which currency to issue in? And are you expecting to launch new bonds in different currencies?
Right. The way the funding program works at OMERS is it is very deployment dependent. And we expect to continue to be active in infrastructure, real estate, private credit as three primary asset classes that use leverage. And so as our teams are able to go and find opportunities to deploy into Europe, Australia, certainly into the US and into Canada, that is often for us a trigger into let's get ready to issue more bonds. And so it is largely deployment dependent. That currency then generates a need. Our treasury team, which I don't manage, but our treasury team makes a decision on how best to fund it, with whether cash on hand, whether to find that source of funds through other means, or whether to issue the recourse debt. And once we get the signal, we get the machine going, doing the investor relations work and whatever is necessary. So we have a primary need in US dollars every year. Since we started the program in 2019, we've been issuing US dollars at least once a year in the spring of every year. We have done Canadian dollars. We haven't done in the last couple of years, but euros and, as you've said, Australia to support our infrastructure and real estate assets there. Our board has also approved us to issue in the British pound. We have not done yet. To answer your question, do we plan to? Again, it would be dependent on deployment. If there's a sizable need there that we wish to fund through debt, you can expect us to issue in that currency as well.
There is always, markets are always focused on rates. So I wanted to ask you about rates and the impact on pension liabilities. And what do, structurally higher rates mean for asset allocation in your case?
Yeah, so I think there's two answers to that question. The first one is probably a general at the plan level, and I think what I would say is, the the discount rates for most pension plans are 5-6%, and I think when TIPS or real return bonds yield 1.5 to 2%, and the plan discount rates are 3 to 4% real, there's probably, if you're running an LDI plan, there's a natural shift back into fixed income assets because you do not need, in order to be funded, you do not need the same amount of equity risk, and that's just a natural sort of way that things have gone.
So you've been taking risk off the table.
I'm just saying, I think that fixed income is a worthy substitute when real rates have gone from 0 to over 2%, and I think it's only natural that that's a prudent thing for plans to do, generally speaking.
And how do you see rates and inflation going forward, and how does that factor into your work?
Me?
Yeah.
So similar to what Ryan said, at OMERS, we have made a significant deployment into fixed income over the last 2 or 3 years, with interest rates being where they are. I would say between bonds and credit, both public and private, we're almost at about 30%, which is historically different from where OMERS has been. Going forward, I think it wouldn't be a surprise. We're expecting rates to come down. Certainly into 2025, maybe still yet in 2024, but not to the point where it causes us to significantly change any expectation around our target asset mix. We still like fixed income. We're still taking a little bit out of some of the other asset classes to deploy into that. And of course, we're seeing inflation trend down as well. That's very helpful, most importantly, to our liabilities, which are indexed to inflation. All of that should help our funded ratio over time, which is, of course, the core purpose that we're all working towards.
When you're doing investors' relations, how do you present yourself to investors? I mean, being a more credit-worthy.
When we sit across from existing and potential investors, there are usually 6 things we like to point out to them. Some of them are completely familiar with OMERS and with Canadian pensions. Others, they have, what your first question was, why on earth would a pension borrow in the first place? And so we explain all of that. But on the first page of our investor relations deck, what we cover is we are a long-term global investor. We have a captive and diverse contributor base. So at OMERS, we have 1,000 different employers who pay into the plan and 600,000 members. And it is very, very difficult, almost impossible to leave the plan. And they have been with us for 60 years. So that's a second strength. We are independent of the province of Ontario. Our governance operates independently of them. As it relates to our debt issuance program, we are, of course, an SSA issuer across a variety of currencies and tenors to enhance investment returns. We always emphasize that. We limit our leverage to 10% of the plan's net assets, and the leverage that we do issue has priority of claim over the pension liabilities that we're fundamentally responsible for. And those ingredients all add up to a AAA credit rating from certain rating agencies, 1 notch below from certain others. We find that if we express those 6 points, usually so much of the story is well conveyed, and then we're able to go into further detail through the conversation.
How do you reconcile the goals of the overall plan, providing returns for the members and having the liquidity, always having the liquidity necessary for the different parts of the organization?
Yeah, for sure. Well, HOOP has a very sophisticated collateral management program. We're active in repo and collateral markets, and this is just one of the tools that we use. When you are working in liquidity management, your goal is to make sure that the whole plan can do what it needs to do and optimize, not just, I guess you could say, there are other asset classes that will take priority over yourself oftentimes. And so you want to make sure that there's enough liquidity around so that everyone can invest when they need to and how they need to. And so, we're just very sophisticated in managing repo and other things so that we can allow for that.
And what are your plans, like how do you divide what you invest in Canadian companies versus Canadian fixed income and overseas fixed income?
Sure. Well, we're a primarily Canadian dollar plan, but like many plans, we have assets all over the world. So the majority of my portfolio is in Canadian dollars, but not exclusively. The intricacies of our market have seen a couple of things happening. You could say that in the case of the provinces, we've had slightly larger programs, generally speaking, and they've done a good job of pre-funding. I think there's some worries about the U.S. election, and so I think the last week I saw provinces are 83% funded, but we're about 53% of the way through the fiscal year. So if anything, that's created maybe a little bit of softer spread environment for that relative to, but they haven't widened. It's just that everything else has rallied in, and Canadian spreads have sort of stayed in the same place. So, you know, to the extent that we want to find value, we find exceptional value in Canadian assets, generally speaking, relative to U.S. assets. That could change, but right now, coming back to Canadian dollar product is actually a really easy trade for us. You know, you get diversification, you've got some really strong issues, and you have sort of prudent amounts of leverage. So
that makes sense. Brendan, why do you invest? Why would you use term debt? Like in which specific situation?
So term debt being, having the fixed rate, knowing that it's longer duration is a natural fit against some of our assets that are similar in nature. So typically when we're investing in real estate and infrastructure, these are 5-10-year assets, if not longer, et cetera. And so again, there's that natural, I'm going to use the word natural hedge again, to have fixed rate, fixed term debt against those assets. Those assets, assuming they've reached a level of maturity, are paying generally a stable cash flow, higher than the interest rate that we're paying on the debt. The term matches naturally as well. And so it's just an elegant way of adding leverage to the portfolio to enhance those investment returns.
Okay. So I'm going to ask something that applies to both of you in different ways. So Ryan, in portfolio management, and for you, it might apply to your funding strategy. So if liquidity is an alpha factor, meaning if you're liquid when the markets are at extremes, then you can take advantage of opportunities that others can. How do pensions value asset liquidity when their liabilities are illiquid, meaning like different from mutual funds that have to mark daily? So exactly, how do you value asset liquidity?
So what I do is probably the least value add relative to the other parts of the plan, right? So liquidity is first and foremost for the team that I work for and for myself. You know, how do we do this? We tend to stay and are going to far more liquid, lower returning things. You know, as the economic cycle kind of goes towards the 8th or 9th inning, depending on where you think it is, you know, you want to safeguard liquidity so that when there is a dislocation in markets, the other asset classes have the opportunity to make outsized returns. So I kind of have to act in a counter-cyclical way to provide liquidity for the rest of the plan to take advantage of those opportunities that we may see in the future. And you could make the argument as well that as asset returns are very strong, the spreads in my market are very low. So there's not that much pickup for me to take incrementally more risk. So it's a very easy trade for me to kind of go up in quality and sort of protect the fund for the future in case we do get a dislocation in equity markets. Other asset classes within the fund will be able to take advantage of that.
What about you, Brendan?
So at OMERS, we like the concept of the triangle where you've got a trade-off between three factors. You can earn returns, you need to have liquidity, and you can manage risk, et cetera. And moving too far on across any one of those sides would move you farther away from the others. And so for us, yes, we need to achieve what is now characterized as the 5% real return over the long term. We must do that to satisfy our liabilities and increase the reserves for the pension plan. That's why we exist. We must also make sure we're providing liquidity for market downturns, to satisfy all the liabilities that could come due at that time, but also to your point, we want to make sure we are able to take advantage. Third, of course, we want to manage the risks that are inherent in both of those, earning too low a return or not having enough liquidity, et cetera. So it is really about that trade-off, that judgment. There's all sorts of scenarios that we're doing through risk and through treasury, et cetera, to make sure. Where my team plays in is we are a strong source of liquidity in those downturns. And specifically, a AAA borrower in those downturns is more likely, not guaranteed, but more likely to have access to the funds that it will need to be able to take advantage of those market opportunities. And so when we keep going with our investor relations and we manage our leverage ratios and we have an active program out there, we're adding to that liquidity buffer overall.
Makes sense. What keeps you up at night as an investor?
Yeah, I think it's inflation. I think the U.S. economy is doing probably a little bit better than the media would have you believe, and we haven't been through a cycle where inflation is 2 to 4%, wherever it might land, and I think what does that look like for assets? What does that look like for the economy, and how do we sort of manage around that? That's probably one thing, and that's probably also for the plan, generally speaking.
What about you, Brendan?
As a debt issuer, what keeps me up at night? I think to characterize it as keeping me up at night is maybe a bit extreme, but where we're really motivated is to get the OMERS name and the Canada Pensions names more and more understood across the globe. And what that will do is that will help us, if we need to access the market during a little bit more of a trying time, that will help us just generally grow the presence and hopefully tighten the curve a little bit more, et cetera, as we go on. So it doesn't quite keep me up at night, but certainly keeps us motivated in what we're trying to do from a funding perspective.
You have not yet issued in an Asian currency, and I imagine OMERS, and I know OMERS is growing a lot in Asia. Is that part of your plan? Like, are you making an extra effort to be known in Asia?
We are making an extra effort to be known in Asia, but not because we anticipate issuing in Asian currencies. Today, OMERS doesn't have all that much allocated proportionately to an Asian currency, apart from Australia, of course, which we've talked about before. But of course, Asian investors like to buy US dollars and a host of the other currencies that we do, including, again, Australian dollars. And so, yes, marketing there, yes, getting our name known there, but not likely to issue in those currencies.
I know you're seeing a lot of value in US Treasuries from a liquidity risk point of view. Is there anything else that you think, like any corners of the fixed income market that you're seeing outsized values that you'd like to share with everyone here, the small audience?
I think Canadian mortgage pools are a very good value. And for whatever reason, I think the buyer base has probably stepped back a little bit, and so there are pockets of value in that. That's an area that we're focused on.
So I'd like to thank both of you and everyone for listening.
Thank you.
Please welcome to the stage Manwit Jahudi, Senior Managing Director of Total Fund Management for CPP Investments, for a conversation with Bloomberg's Derek DeCluett.
All right. All set. Thank you for joining us today. You've got a big job. You're helping to manage one of the world's largest pools of capital. Maybe to start, your title is Head of Total Fund Management Group. Explain what that means. What are the elements of the group? What are the elements of your job?
Yeah, sure. Well, pleasure to be here, and thanks everyone for attending. So, Total Fund Management. Essentially, you can think of total fund management as kind of having two broad mandates. One is on behalf of the CIO to help with the portfolio design and construction. So really all the asset allocation decisions, the decisions we make around geographies and which investment departments we want to ultimately invest in. A lot of that research and engine comes from TFM. And then to complement that, the second half of what we do is really to then ensure that our portfolio is being managed to those targets. And so we have our completion portfolios, we call them our balancing portfolios, which invest across global equities and fixed income. We have our financing program, including our term debt program, which acts like very much like a treasury function to ensure we're at our target level of liquidity and leverage. And all of those pieces come together to, one, help the CIO design the portfolio, and then ultimately ensure that our portfolio is being managed to those targets. Underneath that, there's obviously a number of teams that kind of fit within each of those silos. We have teams that are focused more on treasury-like functions. We have teams that are more focused on beta replication, and then we have teams that are really focused around sort of the tools and research and analytics that we need to ultimately inform our portfolio allocation decisions.
Now, I mean, CPP and IB is in some respects a privileged position. I mean, you've got a super long time horizon. You're getting contributions from most working Canadians. So why does the fund issue debt? What's the purpose, and how does it affect the overall sort of portfolio construct?
Yeah, it's a question we get a lot, and I think you heard pieces of it in the prior panel in terms of the use of leverage. But from our perspective, leverage really goes hand in hand with how we think about asset allocation, and in particular, how we think about adding diversity to the portfolio. One of the things in terms of our investment framework where we start is we very much start with what is the level of risk that we want to target from the fund that we think will allow us to best achieve our mandate of maximizing returns without undue risk of loss. That risk target in the units that we kind of tend to kind of speak in is the equivalent of like an 85-15 portfolio. So that's owning 85% equity and 15% fixed income. That portfolio on its own would be highly exposed to a large degree to kind of growth risk, and in particular, economic shocks like the things that, stuff we've seen, whether it's COVID or GFC. And so one of the things that we want to do is, when we think about leverage, is there a way to build a better portfolio? And one of our core investment beliefs around building that better investment portfolio is a belief in diversification, that a diversified portfolio will outperform over the long run a more concentrated equity-centric portfolio. But when we diversify the portfolio away from a risk target that's very equity-centric, and we start adding assets like credit or fixed income, that naturally lowers the risk of the portfolio. So as we diversify, the risk of our portfolio is actually moving further and further away from our ideal risk target. And that's where leverage comes in. We essentially seek to optimize a portfolio that we think is best diversified, and then we use leverage to get back to our original risk target of that 85-15. So we're not taking on any incremental risk versus where we would want our portfolio to be, but we think we have a better portfolio as a result of the use of leverage that gives us access to cash flows and exposures that we otherwise wouldn't be able to obtain. We think that not only will be a portfolio that outperforms, but we also think over the long run it's a portfolio that'll be more resilient to economic shocks.
So what types of assets does the leverage strategy afford you that you wouldn't?
Yeah, it's really assets that are kind of carry less risk than typical beta equity, and so that's stuff like credit, infrastructure, and obviously government bonds would be the three main categories of assets that we get to invest in. The benefit of that is, if you think about it, if you move away from that equity-centric portfolio, the other nice feature of diversifying is that it gives us a wider breadth of assets that we could seek to monetize alpha or security selection on that we otherwise wouldn't have the opportunity to do. So credit's a great example. We likely would not have the credit allocation that we have without the use of leverage. And by having that credit allocation, we're able to then access markets like private credit that we otherwise wouldn't have had access to.
And private credit has been a big growth area, a big focus. There's been actually lots of hiring by the fund there. Yep. Tell us a bit about what's appealing about that, and how does it look today versus when you embarked on the big private credit expansion a number of years ago?
Yeah, I think we were probably one of the early leaders, so to speak, in private credit. But I think when you think about it, it kind of goes back to my original sort of answer, which was credit on its own provides a diversifying cash flow to the fund, and then the use of private credit we just think allows for better risk-adjusted returns to the overall portfolio.
Let's talk a bit about liquidity and how liquidity considerations affect the active investment strategy. Obviously, the plan is nowhere near mature, but it does mature over time as the population ages, so liquidity comes into play.
Yeah, so liquidity from our vantage point, really, there's a few ways to kind of triangulate it, for lack of a better way of putting it. But liquidity, when we think about it, is liquidity for the needs of managing the cash flows of the fund, including any remittances that we have back to the government. It's liquidity to ensure that we have enough funds available to rebalance the portfolio to ensure that our portfolio is as close as it can be to the targets that we're originally setting through the design process. It's also liquidity for things like dry powder. And then ultimately, it's ensuring we have the liquidity to manage the amount of leverage that we have in the design portfolio. And that's a key link that sometimes folks don't necessarily kind of directly kind of think about. But every time you use leverage, and it's partially dependent on the type of leverage that you're using, but there is a natural demand then on the balance sheet for liquidity, and you need to ensure that you have the right balance in terms of sizing your liquidity portfolio, not just for rebalancing and ensuring you can manage the cash flows of the fund, but taking into account the ALM considerations of your liability book.
I'm going to steal one of my colleagues' question. What's as an issuer, what's the pitch? What's the for CPP?
Well, I think that the pitch for us is really around sort of, again, we're an SSA issuer. It's really about, being a high quality issuer in the space, AAA rated, a diversifying credit, frankly, in terms of the nature of our institution, and obviously having a very, very strong balance sheet on the back of it.
So your group also handles research of a great variety of financial modeling and scenario-based analysis, including geopolitical risk. Yeah. That's a big topic in markets at the moment. Mm-hmm. So maybe you could walk the audience through how that process takes place, and with I guess a focus on the current state of geopolitical risk.
State of the world. Geopolitics is always one of those ones where you can observe it. You know where the geopolitical risk to a large extent is coming from, those that are the flashpoints in the market, as well as sort of, general sort of views around sort of how those could evolve. When we think about geopolitical risk, we really think about it more from a scenario analysis lens, trying to ascribe a specific risk premium that you need to generate because you're operating in a specific region. I think is probably overly precise and is kind of missing a little bit of the forest from the trees. And so from our vantage point, it's really about taking a look at stuff from a scenario analysis perspective. And you can kind of think about that through two lenses. There's the financial impact that a particular geopolitical scenario can have, but there's also operational impacts that could have vis-a-vis your investments within the region, if you have folks in the region. And we try to think about it through both ways. And from the financial side of things, one of the things that we try to do through that exercise of stress testing is not only exposing where you might be at risk or exposing things that you perhaps didn't think about in terms of hidden or second order effects that you won't naturally think about. Those are always the benefit of any type of scenario analysis, but it's really about then taking the analysis and flipping it around and saying, what would you have done differently? So you're in the market today, you know what your portfolio looks like. Is there anything that you would do differently as a result of the scenario analysis that you've run? That could be one question. The second question is, what are the markers then that you're going to look for that would change your view on how you want to manage that risk? And we think through both of those lenses, whether it's the financial side or the operational side of things, that's where the value of scenario analysis can come in, because trying to think about a risk premium or trying to think about what the impact is from a returns perspective is arguably kind of getting a little bit overly precise for something that is frankly hard to quantify. But the value of scenario analysis can certainly help not only expose where you're at risk, but frankly help you think about what you would do if things worsen.
Are you able to give us a specific example of how you used scenario analysis, for example, in evaluating geopolitical risk, and if there were actions that the fund took as a result of it?
I probably won't comment on actions that the fund has taken, but we have run a series of specific scenarios that relate to some of the flashpoints that are in the market today, as well as other scenarios just to sort of test the overall resiliency of the portfolio. Did it lead to specific actions? In some cases, yes. In some cases, no. But we certainly, you can think of any of the scenarios that are out there that you're already reading about in the newspaper, and those are many of the scenarios that those are many of the situations we've already run scenarios against.
What's the biggest risk that you worry about?
Well, geopolitics is certainly one of them. Particularly, if, you just have to pick up the newspaper, or log into your local website or your Bloomberg terminal to see what's going on. I think that's certainly one. I think maybe it's not necessarily a traditional risk per se, but I think there's an interesting scenario around. I'll call it FOMO risk, for lack of a better way of putting it. We've seen a lot of AI, in particular, related run-up in the stock market, continued U.S. exceptionalism. The degree to which that continues, the degree to which there's a winner-take-all market is something that we certainly think about, and it goes. We naturally think about it because we have built a globally diversified portfolio, and when you build a globally diversified portfolio, you've moved away from some of the concentration risks that you see in the market today, whether it's the Mag 7 or whether it's just the continuing growth on a relative basis of the U.S. stock market. And so it's really thinking about sort of what is the upside we're potentially giving up as a result of being diversified.
Where do you sit personally on the thesis that perhaps the AI media is overblown and there will turn out to be a lot of burned investment capital at the end of this?
I'm certainly not the expert in this, and I think many of us are still trying to navigate what AI means, not just in terms of AI in our day-to-day tasks, but AI more generally as it relates to our institution, and then AI as it is an investment opportunity and/or risk. It feels to me it's still very early innings, and I think the pace of change that we're seeing with respect to AI in and of itself warrants a lot of attention. It does feel like there are aspects of it that could be truly transformational, not just from an investor use of AI, but from an overall economic growth perspective. And so it very much feels early innings. I think if you had asked this question a year ago, would we have seen some of the progress would we have predicted some of the progress that we have seen? Likely not. And so it's really hard. It's one of these things that's so fast moving. It's really hard to kind of have a definitive view, frankly.
Can you talk at all about how your group or the broader fund is using it from an operational point of view, as investors, to doing research, to other aspects of risk management, for example?
Yeah, there's a few uses. I think unlike many others, I think we started the journey of AI in terms of the lower hanging fruit of sort of like making our day-to-day a little bit easier. So using AI to perhaps summarize an email or write an email for you, things like that. We've moved on from that. We've built internal tools that are specific to CPP that allow us to kind of pull up specific knowledge or research related to what we're doing. We have tools that allow you to kind of look and ask a question about, is there somebody in the fund that knows X, Y, Z? Again, these are kind of ways that I think ultimately help not only with knowledge transfer, but frankly, hopefully make us a little bit more efficient in terms of our overall investing process. We are starting to think about what that next evolution looks like. And we're thinking about ways in which we could potentially use AI to give us insights into the portfolio. We're thinking about ways that we could use AI in terms of giving insight in how we think about the application of some of our portfolio design tools. But again, those are very early innings for us.
Maybe before we wrap up, we could talk about one more aspect of the sort of scenario-based research that your group does, which is climate scenarios and it's a huge topic for all large institutions, and there's a good deal of societal pressure sort of underneath it. So, what does it look like from your point of view? What are the key factors that you focus on when you're doing climate scenario?
Yeah, I think the biggest thing for us that we've found to some degree challenging is really the data. And I think getting the underlying data, whether you're looking at transition risk or whether you want to think about the implications of physical risk to your portfolio, having the necessary data in terms of how exposed your holdings are to those factors is is frankly a difficult task. And so we've spent a lot of our time just thinking about ways to get the necessary data to think about what transition risk looks like in the portfolio. To some degree, that's available directly because we have large holdings in some of our private programs. To other degrees, we have to work on getting it through public proxies. But having that data, I think, is a necessary cornerstone to do this analysis, and frankly, that's where we've been spending a lot of our time. In parallel to that, we've been thinking about how do we enhance our portfolio design to think about the longer-term implications of what climate could have to the portfolio. Namely, those would probably fall more in the camp of physical risk. But again, it's one of these things that many of those risks are, one, hard to define, but two, are pretty far in the future to some degree. And so we're just spending time to think about how do we incorporate some of those sensitivity analysis and scenarios into today's thinking about what we want the portfolio to look like.
As a manager who's managing other investors, what is your single biggest challenge as a people manager in an organization like this?
As a people manager, I think it's to some degree it's about having alignment on sort of the purpose and goal of where we're trying to move. We've been an institution that's gone through a few evolutions. We're still relatively young as an institution, but we've gone through a series of evolutions that have required us as an organization to continue to find alignment in terms of what's the key priorities. And I think that's probably true for any organization, frankly. But as we think about the next phase of CPP and our growth to $1 trillion, ensuring we have alignment in terms of where we're directing our resources to those highest priority items.
That's all the time we've got. Thank you very much, Manroop, for joining us today.
Great. Thank you. Thank you.
Thank you all for a terrific morning. I'm happy to report that it is now lunchtime. Lunch will be served at Hutong Restaurant. If you all just go down the stairs to the elevator bank, go to the ground floor. When you get out of the elevators, take a left. It is direct, and go out those doors. There's a courtyard. It is directly opposite that exit in the courtyard. Our program will resume promptly at 1:40 p.m. and we will see you all then. Thank you.
Times did I tell you I'm no good at being alone? Yeah, it's taking a toll on me, trying my best to keep from tearing the skin off my bones. Don't you know I lose control when you're not next to me? I'm falling apart right in front of you. Can't you see? I lose control when you're not next to me. Yeah, you're breaking my heart, baby. You make a mess of me. Problematic. Problem is I want your body like a fiend, like a bad habit. Bad habits hard to break when I'm with you. Yeah, I know I can do it on my own, but I want that real full moon, black magic, and it takes two. Problematic. Problem is when I'm with you, I'm an addict, and I need some relief. My skin and your teeth can't see the forest through the trees. Got me down on my knees, darling, please. Oh, I lose control forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. Wanna get numb, go crazy, wanna wild out. Cause lady, life's so short but amazing. Late night party in the basement, hotel lobby and I'm wasted. Just reached into my savings, I'll do it too if you take it. Yeah, life's only what you make it. I wanna get numb and forget where I'm from. Cause looking in your eyes, like looking at the sun. I feel like you're the moon, I feel like I'm the one. I wanna get numb, 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 numb. I just wanna get lost tonight and dance with you. I just wanna get way too high, let's set the mood. You're my fantasy, yeah. I don't wanna fall asleep, yeah. There's nothing in this world I'd rather